What's up, y'all? All right. Let me get the... Oh, I forgot to do the Zoom. What's wrong with me? Oops, where's the Zoom? What's up, y'all? Oh, all right. Right. Ooh. 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 Come on, get in here. Get on in here. Come on, get in here. Come on. Let me post some messages here. All right, let's get everything going here. I need to hire somebody just to post all over my socials every morning. So much I gotta do. Copy. Close. Paste. What? There we go. Post. Ooh, all right, we're here. All right, what's going on today? How many minutes till market open? 6 minutes. Good thing my pre-market check only takes 1. All right, let's do the pre-market calendar. Gotta get on top of things here. All right, pre-market this week. ISM in 30 minutes. Which one is that? The manufacturing PMI. Okay. No. That was Monday. I was like, wait, we already did this. This is Tuesday. I'm already off, man. 1 week of holidays. I'm already out. Oh, JOLTS. JOLTS, big number. 34 minutes. JOLTS going to help imply supply and demand of labor for wages, which will directly correlate to inflation. The probability of Fed cutting rates faster or slower. Beige book this week in Powell speaking. That's going to be decent for Wednesday. Okay, cool. Nothing much overnight. Nothing much here. Nothing much here. Okay, good. All right, so pre-market. Here's our DD bands today. 61, 60, 25. Cool. What's up, y'all? Don't forget to smash the like button, friends. Don't forget, you guys in YouTube, don't forget to go over to, or Zoom, go over to YouTube. Say hello in chat. You guys know the drill. Click the like button. Say hello. Just one time. The bots start posting when enough people start saying stuff. All right. YouTube. What's up? Oh, the most important part of my morning. What the heck? Hold up. Ooh, baby. I take my medication. I forget to do that sometimes. All right, what's up? Good morning. Whatever happened yesterday? Was that kid came on our stream yesterday? Was talking about 11:30. Market was going to crash. Oh man, poor guy. We asked them all morning. Some kid came in here and was like, your stuff, blah, blah. What's the probability of statistics, this and that. Market's due for a crash between 9:30 and 11. We waited, didn't we? Had a busy day yesterday. Bought a washer, bought a dryer, bought a refrigerator. Bought silverware. New silverware. For the new house, we're moving. Anyways, I cut out my trade. And I was like, you know, if I peek at this thing and the kid was right, if the market crashed between 9 and 11:30. Or 9:30 and 11, whatever it was. But like it didn't move. Went straight up. Like we said it would. Sometimes people just get angry when they're on the wrong side of the trade. What's up? Good morning. I feel like you get a lot of the what do they call them? I call them the trust me bro types. I know everything, trust me bro. All right, so we're looking at today S&P roughly close to DD band, 6100 from right here. We're at 656. About 4.5 on SPY. Where are we right now? 7.7. I don't think we're gonna get there today, but just to kind of put it there. How far are we on NASDAQ? Quick and easy. Don't remember 60.68 is the yellow line. It's always resistance. Talk about that's a illiquidity pivot. That's like also in the middle. So 60.68 and a quarter. Just gonna draw here on my SPY chart so that I have it. Okay, so be careful because this is always a high volume pivot, and sometimes this can lead to liquidation. As you see, there's resistance off of these illiquidity pivots. It's a trick. Works every 2 minutes. Let me show you what the cool trick is if you guys didn't know that you can do this. These highs are forecasted weeks ago, months ago. From exactly this day, which is 11/4, I forecasted exactly this high. It is a trick. It is one of our best tricks. It's actually a great trick to pick up chicks at a bar with. Something you can predict. High pivots at all-time highs when there's no resistance. How many people you know look at charts and go back and draw support and resistances from supply and demand zones or whatever? How about forecasting a supply zone out of bounds where we have no history ever trading there? We can. We actually to the tick. We're so good at it. So watch this. Ready? We call it here. They call it yellow lines or short. It's really called an illiquidity pivot. Bam, right there, and it's predictable high volume every single time from a month in advance. And there you go. There's your volume spike, ladies and gentlemen. You can't argue. Oh, hold on. Can't argue that. It's one of our awesome tricks. Remember, all of our tricks here are really awesome. We invented all of them, by the way. The process we have here. Created an house. Teach you how to do it. Look at this. Look at this. Can't argue with this little guy right here. This little guy. Look how small he is. Look at right here. 16,000 contracts right when you pop right up to it. I mean, we're off by like literally right there. So here's that volume spike. The average on the night 2,000, 1,000 every 5 minutes go to 16,000. There's a spike. All right, market's opening. Ready to go. That's it. Forecast a month ago. And there's a trick. You get this number from our table. Market's open right now. Our table gives you these distances. It's called yellow line distance right here in the table. So you open this up. You click right here on the table. Right in the words YL. That is the distance you measure from an anchor point during an event. We had our event class to teach you all about it. Ooh, feels so good. Walk right up to one of our pivots. Now, again, the market will have a hard time inside of here. It doesn't mean it sells off, but this is the exhaustion point of that move that we moved here. So that day we had a catalyst, that event, whatever day this was. This day, this Tuesday, right? This day created this move, and now that particular imbalance has hit the exhaustion point. Doesn't mean it's going to sell off, but it means there's going to be a resistance here. It means I don't long right up against it. I kind of wait for confirmation to get through it. If I long and we get to it, I usually cut out, let it break through, and then turn around and get back in. Marking on the chart. Ding, ding, ding. We open. All right, what's up, guys? Don't forget to hit the like button, chat. Zoom. Don't forget. YouTube. All right, scared of liquidity maps coming through here. Oh, I'm not even connected. That one. They swing a lot. Okay, where's my liquidity maps? Okay, so QQQ way up here. Let's get out of the way. All right, so interesting thing is QQQ, both the resiliences are positive, so that's good. We know that resilience positive. Let's top a box. So no entry at the open. That's not where the open is. Hold on. I was like, okay, that looks weird. Let's go. Let's let it spy really quick. There we go. Yes. Matt's favorite trade. There to there. Matt's favorite. Res is greater than 0. Extra bonus here to here. I'm going to tap it. There to there. I'm going to trade this every single time. Every single time. 80% chance because of hedge pressure this way. 90% chance. That trade. Oh, God. Yes. I love days like this. They're so fun. All right. Let's look at QQQ. Scalp City, baby. Why is the redistribution zone weird on QQQ? That's not correct. Let me hard refresh. Why is my platform being funky today? Oh. We're still working out some of the connection optimizations here. Morning. Good morning. Good morning. We. Connection here. Give me a second, guys. I'm going to close and open back up. Well, waiting for that little 10 point dip, S&P. Scalp it all day long. We're below yellow line too, so I'm going to be a little cautious on that. I'm just going to wait all day long for that. That's scalp range. Now, let me try to reload the indicator. Quick. There it is. My browser crashed for like a hot second there. My browser's been acting funky. All right, here we go. S&P all day long, here to here. That looks good. All right, NASDAQ. Okay, so NASDAQ is kind of like in a similar boat right now. We have resilience is positive. We talk about this. So inside of the box, there is pressure from here to here. I always take this trade every single time. So this is a hold from here to there. So it's a one push move from here to here, and then I X out. So let's wait and see. So S&P, got a little scalp zone right there. Take a little bit of a long here around the edge. $10 scalp on this is all I'm looking for. Edge to edge. I take this trade every single time. Everything's decent for me to hit it hard, so let me see. What's up, guys? Good morning. Res less than 0. Yeah, so with res less than 0, it's not sell-off. It's just now my high of day is here. So if res is less than 0, then I trade it back to mid and trim. My confidence is lower. And then I hold the runners the rest. You guys know the drill. You had this class yesterday. Let's hit it, baby. And we got that yellow line in the way, so we're not going to get big ups today, I don't feel. So basically just scalping right back to start, and then I'm going to be done. I could take big ups on this one. Nasdaq yellow line 21,325. Let's give you guys in chat 21,325. Yellow line in Q. Then S&P is 60.68 and a quarter. Take the trade every single time, baby. Every single time. Take this trade. Every single time. Come on. Res is less than 0, so we're not going to get that push through the box. We had this class yesterday with that. There's a resistance here with res less than 0. So I still take the full trade. I just take what's a normal trade. This is a really heavy trade right here. ED is good. Res is less than 0. We have one tick down. Hit it with a medium. This is a medium. Medium here. As I get through here, I'll start trimming. It's really strong. Probabilities are pretty decent on this one. We have under ideal conditions, which is today, 90% of days will close above here. 80% of days will close above here. It's a strong setup. But like I said, if I'm wrong quick. I get out quick. My Nasdaq just pocketed $2,000. The S&Ps are still kind of like dangling. I hit them both. Made $2,047 on the Nasdaq. Set up. Oh, I thought I hit it with more Nasdaq on a other account. Trading my live Elite Trader Funded live account today. I'm trading my my 20 Apex PAs. A negative resilience again today. The S&P not super hot, and we don't have the Nasdaq being as strong as last time. I still take this trade, but now the R&R is much less because resilience is less than 0, so we have the resistance here. I still manage to take this trade every single time. I might hold my breath a little bit on this one, but I still take it. It's trying to sell today. How's the VIX doing? This is good. This is good there. IWM is supporting. Nasdaq resilience, S&P resilience is just collapsing quick. So it's just like yesterday, pretty much the same setup as yesterday, except we're not getting as much rotation in the tech, but Nasdaq is trying to fight its way higher. In the Nasdaq setup, hedge pressure all the way to bear zone top, all the way to there, and then cut out and sell. This is the bounce point, I feel like, for a lot of these things. So we'll see if we get it. Come on. This is it. So let's see if Nasdaq goes all the way through from here to bull zone. So this is about a 60-point run, and then that basically would be it for the day. S&P just hates us today for whatever reason. Well, 17 minutes. Yeah, we do get it. We do get an event coming through. Even that scalp going live, going good until JOLTS. Nasdaq's been paying out pretty handsomely. The S&P's been kind of delayed today. So I got some keys on the table. I got Nasdaq from here to here, about a 40-point run on this one. I've closed it out a couple times. One of my Nasdaq accounts is up 3,200, 3,300, 3,400. Here it is. It's on another screen. Here it is right here. There's Nasdaq. I got 3 on this one. Three across the board. Three contracts. Longs, baby. I'll take it. Let's go. Bull zone. Holding on. That's Nasdaq's a sexier one. On screen for you guys to see. Sexier one. Resilience is positive. Nasdaq to go all the way to fill the box. Get right there at the tap. We're going to trim. Hold a runner. Trim, hold a runner. The bull zone. So I did. So basically, with the resilience fighting around a lot of things, I'm giving a little less confidence because SPY usually yanks the Nasdaq around. So because of that, I am trimming my Nasdaq at the gap fill just a little bit. Still holding the runner though, just to see if it goes. And S&P hasn't gone yet, but I'm hanging on there. So Nasdaq from here has about roughly 40 more points of move. So I'm talking right close to about at the maximum. Now again, 2040 be probably testing pre-market highs. So I'm holding a little tiny runner here. S&P not giving us some love. Can't complain. S&P is just kind of like being bad today. Bad boy S&P. I know love from the S&P today. You know what I'm saying? I think we'll get it. I think we'll get that push. Let's look at the JOLTS. We got about 13 minutes on that. Not a bad day, but so what happens with the JOLTS are JOLTS is a reading that comes out once a month. It's basically like the logistical bottlenecking of labor. It's an interesting thing to read about. So basically, what a JOLT is the job opening. It's the Joe part. It meets all the conditions. Number one is there's a position that exists with a company. So the company has a position. Like, here's a job. We have it. We need to fill it. We also can hire you within 30 days. So we need somebody. We're trying to hire somebody, and we're going to hire them within 30 days. Then there's also somebody actively going out there and looking in the job pool of like available people and saying, hey, this company over here is hiring. They've got an empty box that needs a cubicle that needs a person. We're looking, interviewing people. So you have a job available that can hire within 30 days, and the recruiter is out there calling people saying, we can hire you in 30 days. So it basically means there's no reason for this job not to be full or filled, with the exception of there just aren't people willing to fill it for the price they're willing to pay. It's pure measure of the supply and demand of this job under these conditions. So is it not paying enough? Are there not enough people to fill it? JOLTS will tell you all the information. And so what's neat about JOLTS is that you can line up the JOLTS, which is basically like the supply and demand of the job, with the unemployment rate. Sorry, the not employment rate, the continuous job jobless claims, unemployment filings. So like basically every Thursday you get the jobless claims come out, right? And these are people who have been laid off and are filing for unemployment. I'm gonna start trimming because I don't want to hold in that event with 4. Not getting that move I wanted yet. I cut my position by 1. Basically, when you put 2 of them together, you can kind of pretty accurately predict some part of inflation. It's pretty neat. So essentially, what you see is since 2022, there's fewer and fewer and fewer job openings. There's only 2 reasons that can be. Number one is so when JOLTS are going down, there's only 2 ways they go down. Number one, hiring spree. Number 2 is firing spree. It goes down in both ways. So essentially, the amount of jobs being created are getting filled faster than they're created, which means essentially we're either in one of 2 places. Are we on a firing spree or hiring spree? If a firing spree, company has 5 accountants and they fire 3 of them and say, you know what, we're going to squeeze by with only 2, then there's fewer job openings, right? There's more people in the labor pool and fewer jobs to be filled. But hiring spree is the same thing. Every job that's available is getting filled faster than they can create them. So which of the 2 is it, right? Why are there fewer job openings? There's fewer jobs, or just people are filling them too fast? Or fewer jobs because economic downturn. So you use these 2 to answer that other question. Jobless claims. If JOLTS are going down, then if it's a hiring spree, then you're going to have fewer and fewer people. Or if it's a firing spree, you're going to see more and more people laid off. Initial jobless claims are the people that get laid off and file for unemployment that first week. To file for unemployment and qualify, you need to be laid off for non-performance related reasons. So company downturn. And as you can see on this tiny scale here, it doesn't look like we're going through since mid-2022 when this thing started turning down. This is relatively flat. So we can eliminate that it's a firing spree. It's a hiring spree. And the way you can double up to determine if it's a hiring spree, you go to the continuing jobless claims. This is the first week filing. These are people that have filed for subsequent weeks. More and more and more and more people here. Now, as you see, you would want this to be coming down really quickly to indicate that it's a hiring spree, which this is not. This is relatively flat-ish relative to history. So it might seem like it's trending up, but it's really just recovering post-COVID. 2 million or less is pretty average. So it's not necessarily a hiring spree. It's somewhere in the middle, because if it's a hiring spree, this would be dumping pretty quick. So instead, we know it's not a firing spree, not like massive wild layoffs, but also people aren't necessarily going back to their jobs fast. So kind of what it is it's just that we are hitting that stabilization where it's kind of like this. People are filling up the available jobs, but then new jobs aren't getting created fast enough. So the economy is like slow roll. It's not bad. It's just like slowly picking up. Like the demand for labor isn't going through the roof. So fewer jobs, more people means wages go down, which means inflation goes down. There you go. Inflation goes down, the Fed is more likely to cut rates going forward. You use JOLTS to make that decision every single time. Pretty good at that. So if you guys rewind this and watch it later, you get all the information about kind of how you can use the JOLTS to kind of forecast that part of inflation. Now, inflation during COVID, that was important during COVID because the reason we had inflation at the start was mostly wage inflation, because there was a huge supply of labor, or a huge supply of jobs, and a very low supply of labor. People didn't want to go back to work because of the COVID thing. So the jobs had to give a whole lot of money to incentivize people to come in. That created the inflation. Now, right now, the inflationary problems are not necessarily related to that. They're related to residual from all of that, but it's mostly what's like supply and demand of stuff, materials. Prices of stuff went up slowly because people, there was a shortage of stuff and prices went up, and then people had to ask for more money to be able to afford it. And then companies had to charge more on the front end to be able to support the overhead to pay the people. And it made this big circle that created inflation. And now it just has to take time to just trickle down as people go to work. And there are more people waiting for jobs and fewer jobs available, which is the situation we have right now. Wages are going to start to come down. And so for companies, sales will start to come down unless they start lowering their prices too. So the soft landing the Fed talked about is just a slow return back to normal, as this type of cost push inflation does heal itself over time. So you're wondering, like, what can the Fed do? The Fed can't do jack shit for this one. They've got to wait it out. And naturally, competition will lower prices as long as we don't go through another wave of firing spree, which I just proved to you isn't going on. All right, let me go open Windows Hot in here. But there's your educational moment with Matt. Let's learn something today. JOLTS going to move the market, and if my luck serves me right, it's going to move the market against me because I have the worst luck in Wall Street. This month is also critical non-farm. All right. Overnight MHP on ES. Oh, yeah. Let's look at that. Thank you guys for reminding me. $60.50 is right here, which is basically right at the low. So let me draw a line here on my S&P chart as well. This is overnight MHP. So we do have some support on these things too. We have a lot of really solid setups here. Resilience is still looking booty today. Like the stocks. So basically, you guys remember from the resilience class, we taught this one yesterday. The stocks are fluxing this way, and the S&P is reflecting that, right? Nasdaq is looking strong again, so we can imply that there's a rotation out of financial, energy, utilities, and a rotation in the tech and comms. So we can go there, the SPY sector. Look at that. Even the two resiliences put together, I can tell you with a high probability of where the money's flowing to. We're rotating out of some of the S&P only and rotating likely into the tech ones a little heavier. So comms, green, technology, flat, industrial selling, staples selling, discretionary selling, and well, I guess I'd say everything's kind of flat. Nothing's really moving hard. But you can see a clear rotation. This is NASDAQ. This is NASDAQ. This is NASDAQ. So they're relatively flat. The other S&Ps are a little worse. Consumer staples, discretionary, things like that. So it's actually not really too terrible. Not a huge amount of rotation like yesterday where we saw everything running into tech. So this is just a flat, it's like a flat market. Things are very sensitive in the middle. I tell myself, okay, we're going to have resistance in the middle right here. Kind of like this wants to move, but we're going to have resistance right here, like a little bit of sludge. So we'll see. Let's see what we get. Y'all ready for this, boys? What's up? Your 2K on in your elite accounts, less than 10 trading days, looking good to make payouts at the end of the month. Ready to pay out. Christos, all right, good job. Somebody in Zoom chat talking about getting their payout. Very nice, very nice. Can I get other liquidity maps besides SPY? Only SPY working for you? I removed the indicator and put it back on, and everything popped up. We had an update. It might have glitched something for you. Go off your indicator and add it back and see if that works. Or reset your settings. All right, here we go. News coming in 1 minute. Fingers crossed. And the JOLTS coming through. Get ready. Get ready for the luck to swing against me and kick me in the face. Got the worst luck in the world. Which is why I don't really like trading too big into news. You do have like literally the worst luck there is. It'd be nice for a quickie red that reverses. I don't think we're going to fly straight up on the JOLTS. I think the only thing that can come out is bad news that would change the mind of the market. These guys came out. This was a miss. This was a hit. All right, here we go. I say JOLTS. Wait, hold on, wait. Right here it is. Ooh. More job openings. That could be... Now, job openings can come from a job creation spree or people getting laid off. And we saw the initial jobless claims, people aren't getting laid off. So a slight beat on this. Actually, no. This isn't a slight beat. This is slightly better than last time. So you will see job openings ticking up when companies are creating jobs. When initial jobless claims are low, which means there's no layoffs, and JOLTS tick up, which it did. It means companies are creating jobs, and you only do that in periods of economic growth. That's good. That's really good. That's not going to help the inflation problem. But hey, start of a boom, baby. How's resilience? Still negative. All right, we're kind of passing through the middle. A little bit of sludge there. Let me trim a tiny little bit at the middle. Just take a little trim, put a runner, leave a runner on. Just a little bit. Just a little bit. Leave on a runner. Half position. Well, maybe asking how are my trades doing today? 0 losers. That's what I got on the board. Those NASDAQs are fucking paying out today. I can't complain. That's good, because I spot $7,000 worth of shit yesterday. I gotta pay for that. I can pay for that. Bought a washer, a dryer, fridge, some silverware, some rugs. New house, new moving expenses. I'm leaving all the old stuff here for the next person. I can get like Resilience is still negative, man. I don't like it. Let's trim down to a 1 runner. You'd also hit that yellow line. Okay. All right, let me just trim everything down to 1. I've trimmed everything to 1. Resilience is still very negative. You know what? Even though I hold all the way 2, I'm just going to flatten everything. I don't like it. I don't like it at all. Well, I know I'm being a little wuss. Now, my normal situation here is to hold a runner. But we did also hit a yellow line, so that's I'm going to give that two signs against me for position control. So basically, what I normally did was like a normal or medium trade. So normal trade, resilience is less than 0, medium. We tapped yellow line. Okay, let's take that small because again, it's still going to have a lot of resistance off that yellow line. And I'm not getting a lot of oomph on the trades I want. So I flattened everything. I'm done. How do I flatten everything? Is there a position somewhere? Oh, hold on. Okay. I'll be flat for now. That's it. That's it, boys. Let's take it. What's up? What's up? All right, hold on. How much is that? 36 plus 17. 46. 53. 63. 71. 78. 88. $9,400. Oh, it's 10K day. Woo. Oh, plus the $400 I made in the ETO. Yes, so it's a 10K day, guys. Let's go. That's fun. That almost, oh, yeah, that does. That pays for everything I bought yesterday. It's been a good week. It's been a good month. I'm telling you guys, look. You may think that you got to catch big runners, big reversals, big order to make money. It's like, this is it. That's all I did. Here to here. Resistance is there. Resilience is less than 0. You guys remember the class, right? Make it big. All right, let me get through it again. How do I have multiple DOMs open? Oh, and the desktop app. Yeah. Lucas, yellow line right here. Again, I should still be holding a runner, but I'm going to go ahead and trim out just because I have, this is like a medium trade that I'm now talking myself away from it. Doesn't mean it's going to sell off, but I'm going to keep buying at the dip. I'm going to let it pull back one more time. It's 60.68. You're looking for the anchor. It's the anchor point from the low on that Tuesday of the big run up. Here. So yellow line anchor 60.68 comes from like November the 2nd or 4th, somewhere in here. What a clean day today. Let me put this in announcements. Yeah, guys, delete the indicator, add it back. It'll work for you. Why did you take the NQ trade? It's the same. It was pretty much the same setup. I'll show you that one in just a second. Let me post it in chat. No losers today. All green across the board. So here's your yellow line, guys, and I'll give it to you. This is one of our favorite pivots, y'all. This is super dope, man. This is it. 60.68. Keep in mind. All right, that's it. Tippy top. Trade setups today. Now, again, I should technically, per our rules, be holding some kind of runner. I've just sized myself down to a sit out. All right, y'all know the rules here. You guys remember from the classes? You have a checkerboard, normal, medium, small, and out. From here to here, I take this trade every single time, right? On the liquidity map, if you go to the 20 days classes, it has all the guides on it. So as you guys are starting to take the classes, is this starting to become routine for you to understand this part? Right? If you know the rules here that I follow, this is always a normal trade. This guy right here, when DD is greater than half, which it is, that's a normal trade. I hit it hard. Okay, so anything I can do to caution myself out of a trade, I'm going to step down. At the start of the day, because resilience was negative, I already basically started out as a medium. I didn't hit it with a fat trade. I already hit it with a medium. I stepped it down because res. Doesn't mean I step it down here. You can usually step it down here because when you analyze res when you get to the middle. I just said, you know, God, we had that thing yesterday. And yellow line, we also bumped against a really strong resistance pivot. Okay, so let me step it down further. Small. And so I should be technically holding a runner from here to here. And so there really is no technical reason why I'm still not in a runner position, which is the small. Sorry. Yeah, which is the small. Other than it just feels off. So now I'm like, okay, it's not a real mathematical reason to have a feeling. It just doesn't feel strong. It feels off. There's no other technical reason for me to jump out of this and not hold a runner other than, okay, do I want 5 points on a contract? Do I want to sit here all day for $250? No. Can it maybe go up there and that work and then it turn around? Yeah, it could. It's not a worse trade, but it feels off and it doesn't feel like we're getting that strong rotation like we did yesterday. And I have like as soon as I saw the spiders, I was like, yesterday we had a really strong rotation in the tech. Today we don't. It's a little less cool, right? So I'm like, okay, now it's a feeling thing. I don't feel like it's gonna move. Nothing's really strong today. So then I go, all right, now I don't like it. Okay, I'm gonna sit out. So you see how like my brain is always picturing a checkerboard like this, right? Like I wish I could just print out a piece of paper and literally like mail it to you guys like this with a checker with like literally a rocket scooter on it. And you tape it to your desk and you move the checker around. So, all right. YouTube says I'm done, or Zoom says I'm done. Everybody go to YouTube. We'll be on YouTube for the next 2 hours, though, because we're going to be watching for some more trades. Go here. Closing out. Rich, I'll answer you. All right, we're back. Sorry about that, you guys. All right, we're back. All right. How about that? Sorry about that. Good morning, everybody. What's up? All right, back. Dude, my encoder crashed like the minute, like literally the minute I switched over. It's a weird process I have to do to take the delay out the stream. I have like a 30-second window to cancel the stream. Then it's still streaming the 30-second buffer. Then while it's canceled, I got to turn the delay off. But then it's like you need to re-log in and re-authenticate. It's so weird. It's like super weird. All right, you guys. Okay. Like I said earlier, I wish I can just mail you a piece of paper. And this is kind of how we teach it. It has this. Y'all want some risk management? So if those of you missed our Black Friday special, you know, our membership is $199 a month to get the access to the platform, all the indicators, all the tools, the Discord, the training, and teaching, everything. Right now, it's 50% off. Try for the first month. Try it. Because when Black Friday, we ripped our courses out of this and we allowed people to sign up permanently to come to our courses forever for $19.99 a month. Like, we're not selling them anymore. It's no longer available. If you missed out, you missed out. These courses are like our bread and butter here. What we do. Anybody that's a member right now, this is still available. We're going to enter a drawing on December 20th for 2 free lifetime memberships. Oh, by the way, I need to contact the previous winners. Make a note of this and give them their free month. I already contacted them, but I need to tell them how to do it. Winners, free lifetime. To-do list. Okay. Lifetime membership is $4,000. Access to the platform forever, no monthly fee, and all future upgrades you make in the platform you get for free. That's part of it. So anybody that joins the membership can come to all the classes. It's 20 days profitability mindset masterclass. It's a position and risk management beauty. If you know what I'm doing right here, okay. So guys, I made about 10K today. Doesn't mean my results can apply your results. Never will I say that. I'm really good at trading. So you may not be good at trading. You may be a student at trading. So my results are just my results. I only share them so you guys know I'm really trading. They hate people that teach stuff, but they, like, somebody tries to teach basketball and they've never been able to dunk a ball. It's kind of suspicious to me. But I teach it's all a risk and position management class. We go over an indicator every single class. Yesterday we covered this one right here and the risk management choices I make to go with it. We give you a liquidity map, which is very simple. It predicts order flow and high volume. Liquidity map right here. One of 8 different setups for a bull or bear run plus a mean reversion in the middle. These mean reversions in the middle have a specific trade setup, and right here off to the right, this is telling me how the flow is going to move. You may see that this has an arrow from here to the middle, and boy, oh boy, that's what we're seeing, right? So I trade off of the flow path, and at 9:30 in the morning, our algorithm prints this. There's a high volume pivot here predictably every single time, and it's 100% correct. It's never wrong to predict volume. Our tools are using options. It's an exploit of options math to predict and forecast volume pivots. There's a volume spike right here. In the middle are the open and close, which we talked about yesterday, are high volume pivots as well. There's your volume spike right here at the pivot. So do you guys see how that works? Those of you that are students that are in the classes, our spread of pivots are 100% accurate at predicting volume because they're exploiting mechanical parts of the market. They are never wrong at predicting volume. Now, predicting the direction, market's random, so you are making bets. But the difference in what we do than anyone else is I'm not making bets anywhere else but here, here, and here. Everything else is noise. Everything else is noise. I know there will be volume here. I know there will be volume here, here, and here. And I know there will be volume there. And I'm only trading where there's volume. Do you all understand that, class? Class here? Everyone here? We get it? So everything else is noise. I'm avoiding the chop. People are always like, well, how do you trade the chop? I don't do anything. I'm flat. I'm zero. I made my money. When everyone else is like, oh, markets are selling off and bearish, I scalped right there and I put 10K in my pocket. And now I'm chill. Now I'm waiting. In the middle, we have an indicator called resilience. This is a tiebreaker exactly here, and it's very simple. If res is less than 0, it pivots this way more often than it doesn't. And you guys all in the class yesterday, do we all? Yes, in chat? Chat, do we see it? Give me a big old fat yes in chat if you see it. There's your resilience resistance, and we gave this class yesterday. And people were like, and in the class, we explained the mathematics behind what resilience is, right? It's an arbitrage thing. How do you guys feel about the class, right? Did we explain it pretty well? People were saying they were like, this indicator is brilliant. What it's an arbitrage, it's a leading indicator. I use it for position sizing only and for exiting. Right? Okay. So one of the things is that at the middle with resilience less than 0, there is downward pressure as you see it right here. This number is less than 0 on S&P. This is the S&P. This is the S&P. Half gap is resistance. It doesn't mean the market's going to sell off. I never use it. What I do is I take my little checkerboard, normal, medium, small, and out. How we do it. What is a normal trade, you may ask? A normal trade is what you normally are willing to risk on a trade. You define it. I define it for you if you don't have an idea of what normal is. Normal is as follows. This is the math equation. Everybody do me a favor. A 10,000 level college course. Yeah, baby, you're going to PhD in trading. All right. Everybody do me a favor. Get out something to write with. I'm going to teach you something. Y'all want to learn something today? You want to learn something? I'm so happy that I just bought my fridge and I was out like $7,000, $8,000, something like that yesterday. I'm happy that I basically came back to neutral, and I paid for my fridge now. Shit's got expensive over the years. But I feel like Best Buy takes a $3,000 fridge and jacks it up to $3,800, then tells you to get the membership so that you can get $700 off. Scamming me. No, it's a total scam. Anyways, okay. Normal. You define normal. Normal is how much you're willing to lose in a day five days in a row. Meaning that you wake up Monday excited to trade and you lose. And the next day you wake up and you lose. And next day you wake and you lose, you lose, you lose, you lose. You lose 5 days in a row. And the worst feeling in the world as a trader is to go out on Friday, to hang out with your friends. And you've had 5 losing days in a row. You've lost every single day. It feels weird. There's a scaling of feelings, okay? There's an amount. This is a graph. This is a comedy graph. But there's a feeling, okay? I got some emojis here. There's a part on that graph where the amount that you lost that week is so much that you feel like you're going to throw up. Your normal is too big at that point. Normal is per day. There's an amount where you feel like, I need to rethink what I'm doing in my life. All right. You're kind of on the edge there. But a really good definition, and again, this is actual science of trading. This is real science of trading, guys. Your normal is after 5 days of losing a certain amount, you're still cool as a cucumber, as they say in my circles of cool people. If you feel like you got kicked in the stomach and you feel like you're throwing up in your mouth, like, oh, my life is over. I'm questioning my existence, which is not as bad as like throwing up, but you're like, I don't know if I'm doing this right. Your normal is too big. Way too big. It's the amount you're willing to lose in 5 days, where at the end of the week, you're like, nah, it's all right. Anyways, what's going on tonight? Who's playing? Catch a game. Let's go to the bar. Let's go chill. Let's go out. So, do you guys understand? Normal is like a comfort thing. How much you're willing to lose in a trade to where after like a week of loss, you don't feel like your life is over. And if you want to write this down, amount is perfect. This is about what it is. It's a feeling thing. You don't want to come back Monday after a week of feeling weird. Okay, now this is a serious graph. We'll teach it with emojis because you guys are. I'll learn this, all right. This and But normal is like, okay, how much are you willing to lose per day, and then have a 5 days in a row where your psychology is all warped and whipped around, and you feel kind of weird at the end of that week, and you're probably betting too big. So the right way to anchor yourself as a trader is to start off with that point, how much you're willing to lose every day. and still be okay at the end of the week. It's not money. It's not money that you have to have. It's not money that you are dying to have. Nasdaq. Why am I not taking every single trade, every single time trade in Nasdaq? I already kind of chose to sit out. I'm talking myself out of S&P. I'm talking myself out of everything. Yeah. So let me go over a few more things. Remember, yellow lines are not anything to kind of joke around. So normally you define, like, for me, a normal is roughly about 3 to 4K a day. Like, if I lose 20K at the end of the week, I'm not going to cry that much. It's gonna, to me, it's gonna feel like I kind of trade like right on the edge. I don't feel like 20K is a decent amount of money, but I kind of feel like this after 5 days of losing like 3 to 4K a day. I'm like here. I'm like this. Usually I'm like, Matt, how'd you fuck up? You never have 5 losing days in a row. What'd you do wrong? But the money doesn't make me feel bad. That's a joke. Really, the money, I'm just like, whatever. I don't ever think about it. It's not money I need for bills. It's not money I need for anything. So the amount is as you guys see my trades per whatever, you know, if I lose 20K in a week, I'm kind of like, ugh, that kind of sucks. Okay, so normal is your baseline right here. This is position sizing 101, okay? You guys might think this is boring. This is the secret to making money as a trader, to have a risk management position sizing system. You don't do this, you're never going to make it. If you don't do this, you're going to lose all of your money, your hard-earned money in the stock market to me. Like, if you don't do that, if you don't learn something like this, I will literally siphon all of your money that you're trading with to me. I will beat you in trading. You are trading against me. You're trading against everybody. Traders like me will take all of your hard-earned money from your pocket and put it into our pocket. Because you're not managing risk. The managing risk and managing position is how I beat Wall Street at their own game, who are more sophisticated than I am in what they do. But I have a position management system that allows me to bet basically on the risk I take in the market. So watch this. So start with the normal. Like, I try to make teaching kind of like goofy and fun too. So like, I'm just being goofy, but our classes are very serious. So don't think that we're just like goofing off in classes. This is the most sophisticated trading class you will take if you take our classes. I promise you that. So baseline is like normal, right? It's kind of like I'm willing to lose. Let's start with me. I'm gonna say 4K a day is my normal. If I lose 4K, I'm probably gonna just pull the plug and be like, whatever. And that's your point of no return. If you've lost that much, you either bet too big or the market went against you. Just pull the plug. Whatever your normal is, if you lose that amount, also get out of the way. Because you don't want to be at the end of the week and feel sick to your stomach and then come back Monday all twisted up and not playing well. Now, medium is half of your normal. Small is 1/10 of your normal. I.e., people call these runners, right? Normal is your hardest trade you're going to hit. Right? It's whatever you're willing to do. Lose 4K on a 10-point stop loss in the S&P. Do some quick math there. That's 8 contracts, okay, per trade. That's me. That's my normal 8. When you see me, class, how many I do today? What was my position size today? 4. Right here. Dude, it's a science what I do. It was 4. I was already at a medium. Yeah. 4. As my confidence started going away, I started trimming. Like, it's okay, let me get out. So basically, I defaulted to a medium because right out the door, I already had some cautions. So essentially what you do is you take your checker and you put it where it starts, wherever you want to be. Now, the liquidity map that we teach, I'll give you guys the picture. The new liquidity map that's coming out actually shows my position sizing guidelines I do against it. So right here, it tells me small, medium, normal, small, medium, normal, whatever for all these different trades. Okay. You click this, the old liquidity map pops up without that. We're about to revamp this and give you guys new docs. So here to here is pretty much always a normal. Under all conditions lining up, I'll hit it normal. The way it works on bull trades is that for every confluence thing that doesn't line up, like every confluence, I'll just do a negative. Every negative confluence, I just move my checker over. So I already started at a medium. The reason of, we already hit a very strong pivoting resistance called an illiquidity pivot. So usually bull moves exhaust themselves and fight that yellow line pretty hard. So I already started off here because of that. We're kind of nearing the top of a run. Doesn't mean the market's going to reverse, but I get out of the way when we hit yellow lines. This is a class you will learn. We teach that as well. It is a predictive thing, and we tap that exactly to the tick overnight. So I already started off here with my 4. And as the day was progressing, resilience is garbage. So that means the S&P is going to have resistance there. So then I move the checker to a small. So everything that doesn't line up, I just convince myself to trade smaller. So if I'm in a position, I'm going to trim out. My 4 is 8. A normal is roughly 1. So I left a runner. I closed everything down to 1. And I was kind of here. You know, about 1/10 of your trade. Like a small is just like a runner. Just that it goes. And then I told myself, SPY is down, Nasdaq is up. Okay, maybe tech's rotating in pretty heavily to keep the market floating. And I looked, and then tech was mediocre. Utilities were selling pretty hard. Comms are down. Everything was kind of muted and flat. There was no big 2% up in any of the sectors. And I go, all right. Yesterday was different. S&P was selling, Nasdaq was rallying, and you had tech was up like 2%. Today we don't get that. So with everything being muted, I convinced myself to close out. So I moved everything to out. And then I stopped exactly here. And the market completely turned around against me. And I could have been red for the day. And I got out of the way based on position sizing scale that just had me trim and trim and trim to where I'm now sitting out. And then somebody told me, why didn't you take bear zone, bull zone, Nasdaq, right, Simon? Because once I convinced myself to sit out on S&P, the S&P is the granddaddy of all things. If SPY gives me the signals to go away, I'm not looking for something else. Remember, if SPY is taken, it usually yanks everything else with it. The one alternative to that is Russell works independently to SPY. I don't normally correlate them, because people could be selling large caps and rotating in the small caps that day. Okay, that happens. So if SPY's giving me a bad signal, what I do is I don't trade anything in S&P and Nasdaq. If SPY's convinced me to sit out, I'm out of Nasdaq as well. We got it. That's it. That's basically it. Ooh, so let's look and see what we got. Market repairing itself. Anything looking solid today? Didn't mean to shout. I was like, what did I do wrong? Why are you shouting at me? Look, man, I can't argue with a solid day like this, right? I mean, it's pretty decent. But I do, so I lined up. So today, right, we have a normal setup here. Normal, which I already came in at a medium. Pressing against resistance here. I trimmed to a small. And as it's like bouncing around right here, not picking up any momentum, I convinced myself just to get out of the way. Normally, I'd hold a runner to there, which again, I was already at one contract anyways. I would be down roughly $500 drawdown across all the accounts. I'd be down like 4K. I'd have held that runner. So a lot of times your final decision-making strat will be like, you know, sometimes a feel thing. I don't feel like the S&P is going to pick up a lot of momentum because none of the sectors are moving, right? And I always have, when we teach this in the pre-market stuff, I always have the spider sector way open here. I always look like, is there strength in the market? Like, where's the big running sectors? Who's looking good today? Nothing's looking good. S&P is selling really hard, and while Nasdaq is bumping up on resilience, you can see that tech is just kind of flat. So what it means is a lot of stocks are sitting right there on the edge where resilience is sensitive to that. So we can go to scanner and tell you basically what's happening is stocks are moving up and down right at the redistribution zone. Let's go to the scanner and find out which ones those are, right? Let's just pick all liquidity maps. We'll do this. We'll pick them all. Put all the stocks on the list, and we're going to sort by distance from half gap. Is it on here? Oh, yeah, it is. Okay. And we'll see like which stocks are right on the edge. And we're going to find some big ones. Like Google right on the edge. There it is. So a lot of stocks, and I can just tell from looking at the chart, are going to be flat and sitting right in the middle of their redistribution zone and not going anywhere. And right at the top, we've got big tech just sitting flat today. Google has gone nowhere. You see that? So you can use resilience, we talked about in the class yesterday, as like a very cool tool to be clever at seeing the things in the market. I can let just staring at these two indicators and then going here, let it tell me a story. Do you guys all understand that tech being flat means that a lot of stocks in tech are literally opening right near their, or they're basically, they're right where they opened. So wherever the stocks are, they're right here. The fact that resilience is being very choppy at the same time, while stocks are at the open, it means a lot of the stocks basically opened flat and we're sitting right in the middle. So a lot of the redistribution zones are going to be like teeny, 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 tiny. And we're just jumping back and forth right here where it's sensitive. And I could tell that just by looking at these things, looking at the sectors. You get really good at this. You can literally say, I bet you some big tech stocks open flat and are kind of sitting right in the middle. And there you go. Pretty cool, right? I told you resilience is like, it's like your Swiss Army knife. People call it your Swiss Army knife in Rogsuiter. You can do so many things with it. Looking at the way that it's distributed right now, I can tell a story about the market without even knowing. And I know to go here and I know to sort by this. And I know there's some big tech stocks just kind of sit in the middle. Microsoft is going to look exactly the same. Right? Sitting right in the middle with a teeny tiny redistribution zone. Nothing big, didn't gap, open and relatively flat, sitting in the middle. You get real NVIDIA, they can do this all day long. Sitting right in the middle, right? So like the point is that you can use resilience to tell these things. It's really neat, right? The website I'm looking at sectors is actually the Spider Sector website itself. You go sectorspdrs.com. There you go. So a lot of times, if I see rotation, let me teach you a little supplement to resilience, right? Resilience helps you, as part of its Swiss Army knife features, which means it does so many things. You look at it. If what this is telling you is the percentage of stocks that are moving through their box like that, in a way. Now, there's a lot more in the class we teach the math, but this is the people that didn't come to the class. I'm in this the quickest way possible. It's a weighted percentage from -100 to 100 of the market cap flux through the box this way versus through the box that way. And then we compare SPY to the basket, and it's going to tell you if there's leading or lagging. When this is below 0, it tells you the stocks have moved this way through this box, and SPY is trading a little bit higher. And that means that SPY needs to come down to meet the stocks. Okay. There's some neat things. In a bull market, you're going to want both of them to be positive, which will show signs of strength. It means most stocks have gapped up or continuing to trade. They didn't gap up and fade the gap. You guys know what a gap is, right? Where you open higher than you closed or open lower than you closed. Stocks gap every single day. This is the basket of stocks relative to their gap. This is telling you the majority of S&P stocks open basically flat because we open at 0. 0 is flat. Sold a little bit. Rallied a little bit, so essentially we opened flat, moved up, and now that most of the stocks have gapped down and are traded down. Or sorry, open flat and are trading down. Trading below the open. Or below the half gap, sorry. Wayne, what does MR mean? Okay, so the way these letters are is going to tell you a couple things. MR is a liquidity pocket, or we call it mean. Oh, sorry about that, guys. Mean reversion means that the market is very liquid. If you stay for like 2 minutes after done with resilience, I'll explain this to you. You guys. So when you have like gap and goes or a strong bull market, you're going to see both the resilience positive. When you see one of them negative and one of them positive between the S&P and NASDAQ, it usually means rotating between sectors. Rotating between sectors isn't bearish. It just means some sectors are bearish and some sectors are bullish. So in this example, what you like to do is just get used to this and write this down. Your biggest typical overlap between NASDAQ and S&P, you're going to have sectors that are stocks that are common to both indices, both indexes actually. So SPY is going to have like utilities, tech, comms. I'm sorry. Utilities, financial, and energy. Unique to that. NASDAQ is going to be mostly tech, and it's kind of like overlap. Healthcare, and then telecom, THC. Mnemonic device. All my 420 friends out there, your THC. You have a lot of them overlap, and a lot of them are unique to NASDAQ. Majority of them overlap. So if you see the S&P selling off and the NASDAQ being strong, it means that these particular things, and you have consumer staples and discretionary as well that are kind of in some of these places, both places. For the most part, financials and energy and utilities. Those are your bigger ones here. So if S&P is down, then the ones that are unique to S&P are selling and then rotating into something that's uniquely tech. So when you see S&P down and NASDAQ up, you tell yourself, okay, financials, energy, utilities probably selling, and NASDAQ should be strong. So then you come to sector spiders and you look at it, and you want to see that exact thing you just said. Okay, I want to see energy down, financials down, utilities down. No, utilities are up. Okay, that's weird. And I want to see tech, healthcare, telecom up. Well, tech is not up, it's down. Healthcare is down. Comm is slightly up. So the rotation isn't strong. I want to see something like 1%, 2% moves in any of the sectors. So right now, what you're seeing is a flat, choppy market where there's not a lot of growth anywhere. All the sectors are pretty much flat, and all the stocks are kind of oscillating around the middle. Then I tell myself, okay, there's not a lot of power here today, so I'm not betting on a big bull up. It's a choppy, flat market. Slight amount of rotation, but because we're not seeing big moves anywhere, it just means that the majority of stocks kind of open flat and are sitting near the middle. So you're seeing the sensitivity of resilience because you're at the middle. Why resilience is having such drastic moves and changes? It's not because the market's crashing. It's because all of those boxes that we talked about in that class, right, are like this. They're really small. And so the majority of the stocks are like, the sectors are up 0.2%, down 0.2%. The stocks are just dancing around a really thin middle, and resilience is drastically moving because it's designed to be sensitive at the middle. But it doesn't necessarily mean the market's selling off. It also means the market's not got a little power either. So then I was like, okay, we're not moving anywhere. Let me get out of the way. So just from looking at this, I can tell we're choppy here. It's because you have stocks like NVIDIA literally right on the edge. Resilience moves very rapidly because of this. Does that make sense to you guys? And a lot of the stocks are moving through the zone as well. So it's just telling you that the market is not picking up bull steam and everything's kind of flat near the middle. Doesn't mean we're selling off. It's just a flat market. There's no sign the market's selling off. Okay, Wayne, your question. Liquidity map is a measure of the positional risk distribution in the market. Essentially what we do with the bull and bear zone is a bull zone is where our algorithm identifies through options. See, I'm trading S&P and NASDAQ futures. So with that, we go to QQQ for NASDAQ futures. We'll look at this ETF called QQQ. And from the options, we'll come up with some information. And these moves are like 80, 90% likely, because this is all back tested. But a bull zone is where there are traders like you that are long or long speculatively, And we should. The ants don't eat my eggs today. Essentially, what a bull zone is where there's traders longing the market more than shorting. We can tell that through options because what we see is that the dealer, there's a market maker of that particular thing that is short against the large amount of longs, and then they bought calls to go with it. The calls, we use Greeks to find the boundaries here. And so when we find these market maker calls, i.e. bull zone, when those calls are in the money, it forces the call sellers to long, which is where you get that bull power. The opposite is true for bear zone. It's where people are shorting the market more than they're longing the market. Implied shorting. And then market makers are long against those. This is the banks, right? The dealers. And so essentially in our algorithm, you can identify where puts and calls are distributed, but the ones that are balanced in neutral trades, divide the market into these zones. Takeaway from this is that this is where the bulls are. That's where the bears are. So wherever price currently is trading, whatever zone that you're in is that first letter you see right here. So the algorithm is giving you the letters just so you can quickly identify what's going on. B for bull, BR for bear. This is BR because we're in bear zone. Hedge pressure is a whole other thing that has to do with delta hedging. This is identifying where market makers have their maximum order flow due to hedging. Essentially, it just is a fancy word for saying high volume pivot with bullishness to it. If you're above this blue, it's an L. If you're below this blue, it's an S. So we're above the blue. That's the L. So we got a BR and an L. And then as the blue is weekly options and orange is monthly options, the U or D is the last letter based on if blue is above orange or blue is below orange. It's just the thing. It's additional upward pressure if your short-term hedging is at a higher price point than your long-term hedging, your balance, right? So essentially the three letters together just basically, we give you the guide anyways, but that's what they mean. And so what is MR? Is that, think about it like this, right? The market's bullish up here and bearish down here. Think like you were long the market like right here. Like this is you right here. And someone else was short the market like right here. Okay? If you notice about the middle is that all the people that long the market, like I bought here and price is now here, I'm upside down. I'm losing the trade. And everybody that shorted here is also upside down. In the middle, pretty much all your bulls and all your bears are losing their trades against, the house. Basically, the most liquid spot in the market is where everybody's collectively upside down in their trades, right? There's a seller and buyer both willing to act because when you're upside down, you're more willing to close your trade than when you're right side up. So the neat part about the middle, that's why the M, we say MR, middle reverting, mean reversion, or liquidity pocket is all the same thing. It's just a place in the middle where your bears are losing, which is all these guys here are losing, and all these bulls are losing. It's like a balanced, not really that bullish sort of area, but it's not bearish either. It's liquid, and liquid markets don't crash. They kind of just hold the fort. So the middle is like resistance to upward movement. It's not going to get a lot of bull power. There's usually trades from here to here we take every single time. But if I convince myself to sit out, I don't take it, which is sometimes like today I did. And liquidity map is basically our invention. We don't use technical analysis anymore. We don't use multi-time frames. I never change the time frame of my candle. I don't use any technical indicators overlaid on my chart. No averages, no VWAPs, nothing. I trade just liquidity. There's a lot of people that do liquidity analysis to become famous for that in the modern day. It's the modern way to trade. So we're like in the forefront of liquidity analysis. Dude, I'm not setting my eggs down because the ants are coming out. I'm gonna eat my eggs again. So like those three letters basically tell the algorithm which picture to show you. In the picture, basically is where the flow paths go. Each one of these levels are high volume pivots. They're predictable. This is high volume. This high volume. This high volume. Now some cool stats, right? Wherever you open, there's a trick. 80% of days will close at the end of the day on the same side of blue. So 80% of days will support here, right? As you see, the guide, when the price opens here, can bounce in blue and come back. This is 80% chance. It's back tested. We shared the data with our group. So when we open here, my brain goes, aha, I'm going to long here because 80% of the days will close somewhere above there. Another rule is that whatever zone you open in, under ideal conditions, which we kind of do have today, you close in the same zone roughly 90% of the time. So the L and U, right? If you open L, 80% of the time you close L. You open bear, 90% of the time you close bear under these ideal conditions. Eating eggs out of a bowl, that's the best way to do it. Dude, we have an ant problem here in Texas. These fuckers crawl everywhere and eat my food. I saw my eggs here for like 10 minutes the other day on the stream, and I looked and there was like 100 ants in here. There's like pepper in the eggs. So at first I just thought it was pepper, and I stuck my fork in, and the peppers started scurrying around, and I was like, oh wait. That's not pepper. So the bowl gives me some buffer to the ant problem. So as you see with Nasdaq, Wayne, is it surprising that the market is pivoting between these two high volume pivots with these probabilities? Pretty cool, right? You see that? It's doing exactly what our stats imply. So if I were longing, I'm longing somewhere down in here. If I'm shorting, I would be shorting somewhere up in there. Yeah, it's putting up a big fight here. So anything that has options, we could pull the same thing. So I'm trading futures. Like I long QQQ, and I exited right when we filled the gap. I closed down to a runner, then I convinced myself to close everything out. Market moves to here. I'll trade to there almost every time and X out because I expect it to pull back in there 90% of the time. So this is a very high probability setup on QQQ. I longed right out the door. S&P, it's the same boat when you open in the middle. The middle has a different kind of setup. In the middle, it's also the same rules. 90% of the time, you expect it to close in the middle. So when this ratio is greater than half, I take a trade from here to here. The very heavy position, my normal size position every time, which I lined up to do. This indicator tells me what this dashed line, which is a whole different indicator, is likely to pivot away. So I had long pressure from here that's likely to stay inside of here. And I have resistance right here at the same spot in the middle, coincidentally. So while there was a trade this way, it bounced against this resistance I have because this is telling me there's resistance there. So I expect 90% of days to close inside of here. And I tell myself, okay, we're not going to really be trading a big bull breakout. And then this other indicator told me, we're probably not going to break that either. So this guy is like destined to close somewhere in this area right here. So because of that, I'm not any long trades from here because the risk and reward's not that great. And I don't have any pivots to buy off of from here. So I can look and see like where the probabilities are. So 10% of the days we break out one zone or the other. And when that happens, the market's just being random and I don't want to play it. So like, what am I going to do here? Nothing. Wait. If we break through here and bounce right there again, I'm going to take another long. From here to here, I take this trade every single time. If this is negative, I'm going to exit out right there. If this is positive, I'm going to exit out right there. Because I'm not betting on big breakouts because, again, 90% of the time, I expect flat days to be flat. You got 480 bucks? Dude, good job. Okay, hold on. Yeah. All right, boring day today. So because the greater market stuff is all bullish, I'm not shorting it either. So as we talk about in our classes, right? All I'm doing is waiting for an entry point on a confirmation. I need confirmation. Here, belong at least to there, and then maybe there. This is roughly 10 points ES. 10 point stop is 1-to-1 trade. You started eating out of a bowl because you were sick of the egg sliding off the edge of your plate and getting on the table? Dude, the physics of a bowl, eating anything in, is like by far, like I don't eat plates anymore unless I'm trying to impress somebody. Like if the queen or king comes over to dinner, I want to impress people, I'm gonna serve them food on a plate. If you're just somebody I know and you're coming over for dinner, I'll throw in a bowl. Bowls are the best. Overnight MHP on ES so far apart. We mean overnight MHP not strong. No, the MHP is still the same strength, no matter how. It's independent. So MHP is just monthly options, the orange one, and the blue, which is just weekly options. So they're independent from each other. They have different reasons to be. I wouldn't try to correlate like the distance between them as the strength of the monthly. The strength of the monthly is its own world. So basically, some of the odds that we have, and again, we teach you this in our class, is that 90% same zone close under ideal conditions, 80% same side hedge pressure under ideal conditions. So there's some powerful hindsight about my eating habits. So, I'm leaving for opportunities today. S&P, I'll wait for bear zone breakout. NASDAQ is trying to fight. Remember, NASDAQ has just been flat and choppy. There's no bear setup today. Everything's strongly bullish, but there's not a lot of action potential here. Maybe here to here for one more lucky move for the day, but it's roughly 60 points in Q from the middle. Rest is just above 0, so it's kind of there. This is an every single time trade from here up to there. I could maybe take it if I wanted to, but with the S&P already convincing me to sit out, I'm gonna go ahead and sit out, even though I don't think the market's selling off. I don't think the market's selling off at all. I just want to see improvements. I want to see maybe resilience above 0. I want to see a little bit, but yeah, there's not like a. There's always a trade from here to there with a 10-point stop. What if I just did it with one contract? Nah, I'm over trading. I'm already up 10K. I'll call. I'm not gonna do it. But if one were to do it, here to there is with a one-to-one setup. Ooh, man, we are growing so fast too. It's crazy. It's like 3 weeks ago, our YouTube channel had 10,000 subscribers. We have 13,000 now. We got 3,000 subscribers. It's like 1,000 a week. Pretty crazy. Should I get an excuse just now? Probably, yeah. I would have just done one contract at it, though. The S&P, this market's just like flat, and of course, flat liquid markets, I still bet to the bull side. Trader Funding is having a 1 million total in sim funded accounts giveaway. Giving away a bunch of accounts. Oh, very cool. 15 elite sim funded accounts with the first month activation fee covered. How do you enter this thing? Grand prize. What do you do? How do you enter? Buy any val. Oh, this is cool. All right, here we go. Look. All right, do me a favor, guys. If you guys do ETF, all right, let me give you the link really quick. Okay. If you guys use our link and buy ETF accounts, Elite Trader Funding, we have drawings, and we're going to start doing them at the first of the year. Every $250 people spend with these guys using our link. Every $250 you spend, you enter in a drawing, and it's going to be for like lifetime memberships and stuff here. Basically, like rewarding you guys for your, for any trader funding stuff you do. Turns back. Remember, using our link enters you twice into 2 drawings. Okay, this is cool. Neat. Okay, so here it is. How to get NQ res graph to show up like this? Right here. Click indicators and type resilience. RES. And then grab the 2 right here. And it adds them. Liquid Packet MQ. Yeah, so SPY is pushing back up to that like every single time zone. So QQQ, that trade, I would have taken with 1 contract. There it is. That's the setup. You guys that got it. Good job. There's the setup. I talked myself out of taking it though. So I use a trade copy. No, I don't. I don't like to treat them like one account. I like to manually do everything because I'm super old school like that. Doesn't mean traded copiers are bad. I just don't do it. Markets are falling. I enter in a couple of the accounts. They fall a little more. I enter into a couple more accounts. So I get better cost basis averaging if I treat them separately. To get to jump all in on all your accounts at one spot is a lot of, I mean, you're trying to be exact on everything. So like I said, if I get like a couple points from hedge pressure, I'll long in 3 of them. And if I hit hedge pressure, I'll long in 3 more. If I drop below hedge pressure, I'll long in 5 more. Like I do that. And it works very well, actually. Trade copier is too risky because all of them can draw down exactly the same amount. Utilize the fact that you're trading multiple accounts to allow you to cost basis average into your overall position by allowing yourself to enter lower on the other accounts. It's like we teach you how to beat the casino at the sim funded game. These are tricks. There are tricks to that. Trust me, take our courses. I will teach you how to game the trader funding system. There are tricks to walking in to play their game and walking out with their money. Trade copier is a thing that allows them to beat you more. And you beat them. I tell people don't do it. Not against the rules. Market falls to here. Like, say an example. If I'm going to make up a trade. If I was going to long... Actually, let's do this. If I was going to long from here to here. Market is... Right. From here to here. I'll long from there and I'll exit there. So if I just tap it with like 3 or 4 accounts, right? All of a sudden, those 3 or 4 accounts are taking drawdown. Oh crap, oh crap, oh crap. And all of a sudden, you know, like it falls to here. And then resilience slips positive. And I go, aha, we're going to move to the top of the box. Cool. Let me long in 3 to 4 more. Cool. Now I've got some of them cost bases here, some of them cost bases here. So now my overall cost basis is here. Like I've lowered my cost basis by trading multiple accounts. No rule against doing that. Well, market falls to there. I've got 10 accounts on standby to grab the long here. And then they win. I could stop out of that one. I could stop out of that one. I could play this one. And they're all survived. When you trade copy, you're just basically saying, I got to get this trade right from here. And you get no wiggle room from there. And trade copying is allowed because it makes you blow up faster. The stats are overwhelming that a trade copier will allow you to blow up like super fast. ETF one-time activation. They released a statement about that, and again they raised their fees for some reason. And they posted in our chat something about an announcement they made. Recent announcement. What was their announcement? Let me go read it real quick. What'd they say? Where's the announcement? We take ownership of the miscommunication regarding the recent increase in one-time elite activation fee. This change was intended to align with the launch of the new 3D add-on, which allows you to meet lock-in savings elite activation. Please rest assured that our dev team is actively working on a solution to honor the previous pricing for elite agreements before December 1st. We're committed to making this right, ensuring you receive the value you expect. So they basically just made a miscommunication. Neil, you asked about using trade copier. I just answered that question. Absolutely do not use a trade copier for any reason whatsoever. I recommend that you guys don't either. Because trade copier is forcing you to be accurate on that exact spot. If market can fall to multiple pivots, then I'm going to split up my accounts. Some of the accounts I'm going to trade there. Some I'm going to trade here. We can trade all of them at the same spot. Because you're treating it like one big account with multiple entries, then trade some of the accounts from there, some of the accounts from there. You say that I'm going to get them all right and copy all my trades in one spot. I don't. Essentially, pretend that the market's falling this way. I'll long in one account, long another account, long another account, long another account. I don't necessarily do that. But strategically, there's a better improvement than to longing all of them right here and blowing all of them up. Trade copying is allowed and encouraged, and your influencers out there are paid to trade copy on their streams because it's a marketing trick to convince you to do it because you blow up more. I know everyone in this industry, and I know all these influencers, and I know how much they get paid to do this. I know everything. It is one of the biggest marketing things. They are literally said, go on your stream with 20 accounts with a trade copier. We'll pay you hundreds of thousands of dollars a month to do that. It's very profitable for you to use a trade copier for them. Statistically speaking, you can't predict the stock market. So the more they force you all into making one bet at one spot, the higher the probability is you're going to blow up all your accounts at once. A trade copier is a design feature of the casino to make you lose more. That's why Tradeovate allows it in their little program they created. So all these people that create these funding programs can create multiple accounts. And do you know Tradeovate makes like $35 per account that you sign up with at these funded programs, and then $5 for each add-on account that you can make? They literally just rake in money. And they give you a trade copier to tie them all back together. It's so weird. They give you a fake thing that's worthless, a paper account, and they chop it into 20 arbitrary sizes that's still 20 amounts of nothing is still nothing. And then they charge you each time you do it, and then they give you a copier to tie it all back together in one account. It's so weird to me, but you all do it. You are being gimmicked by these influencers to use a trade copier. You might make a dice roll and you may accidentally roll into a 20 or 30K payout. Good job. It's not going to happen every time. You want consistent money. Use the accounts against each other as a technique for dollar cost averaging. So the idea is that you're being gimmicked to trade with more risk, which is what you're doing. Your probability is very low. You will pick the exact spot to long from to avoid the drawdown limitations of the account. So to throw all your eggs in one basket, you better have the best trading system in the world. The trick is, the way to make consistent payouts is to use your accounts as tools for dollar cost averaging. You use their system against themselves. You don't break the rules because it's not a DCA. You long in one account, long in another account, long in another account. You may bust the first one and make profit on the next two. And when they have their 90% off sales, you go out there and start the process all over for 20 bucks. Money will flow more towards your lap if you don't trade copy than to their lap if you do. Just keep that in mind. Just ask the ETF, if you purchase before December 1st and you pass, look at the 80% activation fee. Yes, if you purchase the eval before December 1st and pass, you'll see you're eligible for the $80 activation fee. Cool. Add a new account to the copy trader. You trade like I'm on the newest account, just a couple micros. Once the account grows, I'll up your position, then lower it again, add another. Yeah, and I mean, everybody does it the same way. I'm just saying, statistically, the trade copier is a design feature for you to lose faster. You may have a way to do it and win, and that's totally great. Statistically, everyone's losing more. So just keep that in mind. You have to pay if you don't want to trade them. Can I tell you something? Can I tell you something about trader funding programs? The only reason they tighten their risk is when they're losing money, which means you're winning. And it seems like lately a lot of people have been winning at Elite Trader Funding. Thank you, Rocket Scooter. You always just think of it like a business sense. We love ETF. And again, you know, we support them. The only time they tighten their risk is when people are beating their system, and obviously, we've drawn I don't know how many hundreds of thousands or whatever dollars of sales to them in the last couple months, and people are going in there and winning. Rock Scooter, coincidentally timed with some price raises. I mean, let's just be real here. It's good. It's good for us. Neil Switz 20 accounts and 4 sets of 5. Yeah, that's exactly how I do it. I trade them like lumped together. I still don't make them like copied, but I have them split up where I have like a bunch of DOMs on one screen. I'm like, oh, okay, I've got 3 entries nearby. Okay, let me just long in these 4. long in these 4, long in these 4. If I bust, it only cost me a couple $100, but the ones that win was at 10K today. Yeah. Wait, to pay the activation fee is $360 to activate the is that lifetime activation or monthly activation? I can't. So they promoted me to live, so I'm in like a live funded account, so I can't play the eval game anymore there. Lifetime? How much is the monthly? Don't do the lifetime. That's the same as Apex. Apex is, well, actually Apex lowered their lifetime. Just do the monthly. If you don't get a payout in a month, just blow up the account and start over. These guys, y'all need to listen to me when I teach. God, y'all need to listen to me. Don't pay the lifetime. Jesus Christ. No. You will either make a payout in a month or you will blow up. Okay? This is the stats. There's no reason for you to ever pay for more than 1 month for these things. Never. Never, ever, 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 ever pay for a lifetime sub to a funding program. Please don't. You're either going to make your 10 or 20K in a month or you're going to blow up. It's one of the two. Don't buy lifetimes. Buy the monthly. Because every month or two, these companies have like 60 to 80% off sales. Your job on how to game the system is very simple. When the sale is here, buy all that you can. Stock up for like 10, 20, 50 bucks. Buy all that you can. And then you have a ticking clock of 1 month to pass the eval and get to funded and pay just your minimum, whatever it is, 80 bucks, 100 bucks, 75 bucks, and just pay that. And you get your payout in a month or you're going to blow up. And then one of those two will happen, and by the time one of those two will happen, they got their next sale. Labor Day, President's Day, Martian Day, Sun Supernova Day. There's always a Black Friday. There's always a sale going on. JFK, if you're making $80 a month, fees not the problem. Yeah, don't go out there and buy the lifetime fee. Pay the cheaper one, blow up, start over for 20 bucks. It only takes 1 day to pass an eval account. And then you tick the clock for the other 4 days. There's a trade minimum eval of 5 days, I think, with ETF, right? I passed all my evals literally in 1 day trading NASDAQ. When they're 10 bucks, I just brute force them all. I passed all 20 of my ETF accounts in 1 day. 1 day. I might have blown up a bunch of them, but I got 20 in a day. Might have cost me $300 or $400. Not that long at all. Not that much at all. Pay your 80 bucks to kick them out in a month. And then within that month, you got your timer of what? Was it 10 trading days now or 8 trading days? Whatever it is with them. You have a timer to make your profit. If you last 10, 15, whatever days to get your payout, take your payout immediately and start the process over at the next sale. If they're not having a sale, you move down the street to the next one. Don't try to balance these accounts for growth over time. Get to your 10 days, get your payout, close it down, don't activate for another month, and take that money and put it into a real futures account so that you get 60-40 tax rule and trade on your own. I've been teaching this lesson for years. That is the way to do this game. Don't try to be sim funded for more than the minimum amount of days it takes to get a payout. Once you get your payout, take all of it. Statistics will show you will blow that account up. Now, if they don't have trailing drawdown, then yeah, you can keep maintaining that account and then you pay every month to keep it going. But the idea is at the end of your whatever days it is to get your payout, take all of it, as much as you can. Because you are getting wrecked. 20% of your money, 10 to 20% is going in profit share. 35 to 40% is going to taxes, depending on how much money you're making. You're losing 60%. And then on top of that, activation fees, monthly fees, all of that. On top of that, you're losing more than 60% of your gains in sim funded to all the auxiliary costs. Your take-home pay is 30 to 40% of all your effort. Do you guys understand this? I'm spinning fire here. Your goal is to make your quick money and then go trade on your own with it. You're taxed at about 20, 25% at that point, and there's no profit split. So don't, like when you guys are mad because they raised the lifetime fee, it's because, no offense, you're not learning how to beat the system. You're letting them play you. And so you're here to learn. Not everyone can trade their own money. Is it because being in another country? If that's the case, you're limited by whatever you can or can't do. Because Icewild, you're not in the States, right? You can't trade. Can you not trade futures or something? So just listen to me when I teach you the rule. Max out when they're cheap. There's always a sale somewhere. Move from this firm to this firm to this firm to this firm. Whoever has the best sale going on, stock up on as many as you can. Pass as many as you can. ETF was 5 days. I beat them all in 1 day. Every other day of the 4, I opened and closed a micro and ticked the counter forward. There's no rule against that on the eval side. So do it. My job is to turn them and burn them. Get in, win. Get in, win. Blow up, whatever. 20 bucks, get another one. When they're cheap, the goal is to just get through them as fast as you can. Pass them, and then flip them to funded. Then you wait for your first trade to be your best trade. Amazing setup, like this one. Or whatever. Get right off the starting point to where you no longer have trailing drawdown. Typically, the trailing drawdown will stop at a certain point, and then the account grows. That's what you want to do. So your first trade is your most important trade. If it's 5 days to trade or 8 days to trade or 10 days to trade to get a payout, follow all the rules consistently. Don't blow up by getting too big of a trade where it forces you to trade bigger. Follow all the consistency rules. Try to make your 2,000 or 3,000 a day consistently. Pay out of all of them, and then you're done. Take that money, move it to your own account, trade it that way. When tax time comes around, you got to remember that money that you took out, you're going to pay taxes on it. A lot of taxes on it. But hopefully, the gains you make in your real futures account can pay for the taxes you're going to owe on it. What U.S. futures broker do I like to use? AMP, Edge Clear are really good. Iron Beam and Cunningham are newer and growing. Phillip and Dorman are like mainstays. Phillip, I think, is like the most used, I would say. I use AMP because they only have a $100 minimum deposit. It's like the lowest deposit. So most of the futures brokers have like $500 minimum deposits. Problem with doing that now is that you're forced to trade them all, or you'll be stuck paying monthly fees and the fee goes up. Well, that's a sword. You nailed it. That's why the goal is to get your payout within the first month, and then you don't care about the monthly fee. Your goal is to make $80 in each one of those accounts in the first month, which is easy to do. You're going to either make $80 or going to blow up. You're going to make $80 within the first 1 minute of your first trade, right? So you have a month to get a payout. You have to think of it like that. And if you have 20 accounts at 80 bucks, you're going to be funneling out $1,600 every month to keep the system going. If you didn't make $1,600 a payout in the first month, right, to pay for that, you're a pretty good trader if you're still in the game. If you somehow survive 30 days in the funded world, which is designed to squeeze you out, and you're paying the second month, pat yourself on the back. You guys understand what I'm saying? If somehow, like, it's in your head that you're going to be lasting 2 or 3 or 4 months in a funded account, if you've made it past the 10-day window and you're still going, you are a good trader. You need to think about that. And if you're a good trader, you should have been making more than $1,600 combining all those 20 accounts. 95% of you won't make it past the first 10 days. These are stats. 95% of you will blow up in the first 10 trading days or less. It is rough for full-time working peeps. So for full-time working people, the best time to trade, you have 2 options. Number 1, overnight. We have overnight dynamics, which are helpful. In the morning, the first hour, which is kind of hard for people that can't actively watch it. That is tough, I know. Unfortunately, day trading kind of requires you to be available in the mornings. That is hard, I know, Sword. There's not really any solution for that other than you need to take 2-hour-long shits every morning. It's kind of like when I was an engineer in trading. Like I was, when I lost my job in 2010 and started trading, I still was doing like part-time engineering work and contract work for about 4 or 5 years after that. I was a guy that have like my phone in my lap while I'm in a business meeting and I'm like staring at my ass, like staring at my crotch. Like people are talking and I'm like staring at my phone because it's like down here. It's so obvious that I was not paying attention in the meetings. Like having around the meeting to quote unquote go to the bathroom. They probably thought I had like irritable bowel syndrome or something. I was always going to the bathroom. It's tough. That's why you got a night shift job. There you go. Leadership. That is the problem, is like trading at work. So you have to find a time consistently. There's a couple ways you can do it. Sometimes people tell their boss, hey, look, I'm going to trade for the first hour of the day, but I will stay an hour and a half after work. Is that cool? And they may be cool with it. It's win-win for both of you. It might not hurt to just ask your boss, hey, I have a, because I know people that do this all the time. Hey, you know, somebody goes, I go to yoga every morning at 8 or something. Can I come into work an hour late? It'll be consistent and I'll stay 2 hours every day if you let me do it. And sometime your boss will be like, yeah, that's cool. So the worst they can say is no. You don't even have to say you're trading. You say, hey, I've got a thing to do every morning. I gotta drive my kids to school. Make up some lie or something. You don't tell them what you're really doing. And make a deal with your boss. Hey, I'll work through lunch, or I'll stay an hour over. Can I come into work an hour late every day? I'll more than make up for it. And I've known a lot of people that made deals like that. If you say it's like a family hardship or something, they kind of feel like a dick if they tell you no. So that might work. Work from home is one of the ways to go. That's in the modern day. You can do that. Or look for mean reversion days, like at lunchtime. And these are set and forget it. So a lot of times, these trades right here are really set and forget it. There's not a lot of activity in a mean reverting trade. You set a trade, you set your stop, you set your exit, just like that. And it's automated at that point. You might even have to look at it. So if you wake up, peek at the liquidity map, and go, okay, I've got some pretty sizable one-to-one trades, and you can automate that. Bear zone, bull zone, highly automated trade. Bear zone bounce, highly automated trade. Bull zone bounce, highly automated trade. MHP bounce, highly automated trade. You can automate it. You don't need to be watching it. You know where you get in. You know where your stop is. Or all or nothing setups, and then just take them. So either work from home, make a deal with your boss, or try to take only the high probability trades that you know you can like maybe automate to make it easier, right? Neil has a bot that automates the levels. There you go, like some kind of bot, right? So you can set it and then like go about your day and then just leave it like that. Bro, this is like a great day today. Can't complain. How much did we do today? How much did we make today, chat? Let's do the math here. Let's just mentally add up. 36, 17 is 53, 63, and 9, 72, 79, 84, 89, plus 6 is 95. 9,500 bucks. Plus 500 in ETF is 10,000. I'm at 10K today. Yeah, about 10K. And the reason they're all different levels is because I'm not trading them tethered together. For some reason, this one got all the love. I don't know why this one was bigger than these. Other than I might have accidentally had the same DOM open twice. I think I did. I think what happened on this one was like, because I remember at the end of the day, when I closed them all down, you heard me on the stream, I was like, oh, I still have one that's open. That's weird. Because what I think I did was I had the same account open in 2 DOMs, and this one was focused on NQ, and this one was focused on ES. And I think I accidentally entered a long trade in both. And that's probably why that one went up. Because whenever I closed everything out, I still noticed I had an active position of 3 NASDAQs still open. With a open profit of like 1,500 bucks. And I was like, huh? I thought I looked on my screen, all the DOMs are flat. But then on the account window, one of them saw a position. So that's probably the likely reason I accidentally entered a NASDAQ and an ES trade today. How much I'll make today? I made some money? Let's go. Good job, good job. So, NASDAQ was here and ES, potentially. These two were NASDAQ. These 3 were NASDAQ, and then these were all basically ES. Notice how they're different amounts? You're gonna see me trade like that. I don't play the tandem game. Did you guys like the lesson today? Look, trader funding program, with all due respect, you know, I'm batting for both teams. I like, you know, convincing you guys, you know, of the proper way to treat playing the game at the casino. I know the rules of the casino. I know how to beat them better than most people. And a lot of times you don't understand because there's a lot of intricacy that kind of like if you read between the lines, you can understand what's going on. I'm also batting for the team of ETF and helping them sell subscriptions because of all the companies out there, I think that, you know, basically them and Top Step are like the 2 ones that like don't have payout issues. Right? So, you know, if trader funding is a big thing, you know, we're going to stand by some of them. So to me, a firm that just doesn't have payout issues is the safety net you guys want. You want me to put my name on something, I'm going to say, okay, I'm not going to support a firm that I can't guarantee is not going to screw you over. So to this date, I haven't heard of crazy payout issues. I've never used TPT before, so I wouldn't know. And I heard funded futures is good too. But again, I've never used some of them. But you guys want to know a good one to trade. And now, you know, my allegiance is to Matt. I'm here to make money. I'll tell you one thing, ETF has never tried to police what I say, which is good. And I know the other influencers are policed what to say and how to say it and how to sell it. And they get paid big bucks just to shut their mouth and do it. You actually say you need to say this and say this and say this. They actually do that. With the paycheck the influencer gets, they ain't gonna say anything about it. A lot of influencers drive Lamborghinis now with that same arrangement. So here's a couple rules of thumb. Ready? Number 1, tethering your accounts all together. Bad idea. It's designed to make you lose faster. Don't trust the influencers that do that and post big payouts on a big list that does this. And it's all like, look how much you made in my 20 accounts. They're paid to say that. Number 2, get in, flip them as fast as you can when there's a sale. Pay all of them the cheapest activation fee you can find. If it's monthly, weekly, yearly, whatever, the cheapest activation fee, because your goal is to try to get payout in the first X amount of minimum days. And then you've achieved your goal. And from that point forward, anything else is bonus for the rest of the month. Take that money, trade it on your own. If you blow up your own money, start the process over. There's always a sale going on somewhere. Get your evals when there's a sale. When there's not a sale, move down the road and find a company where there's a sale. If you've got 20 accounts and you blew up 10 of them and there's no sale, the minute there's a sale, re-up to get your 20 back or your 5 back or your whatever amount back. Consistency rules. When you're active in your eval account, there's usually no consistency rules. So game the system as much as you can. Swing for the fence. Pass all your evals in a single day. Trade a micro every other day to advance the clock. Get funded, you're done. Now, you can't do all those tricks in the real send to funded. In the send to funded world, you got to play by the rules. Consistency rules. Typically, you can't win too big in one trade. Also, with some of them, your biggest trade ups your minimum for it to count as a trading day. Like ETF, if it starts off $100 minimum for it to count as a winning day, you have to win $100 for it to count. Losing doesn't count. So if you make a big blowout win, then your minimum goes up. If it's 23% rule, if you make $10,000 in a single day, now you have to make $2,300 every day just for it to count. It forces you to trade bigger and overtrade, and the probability that you bounce into your drawdown is higher. Now, if you have a 10K day at the start, it's really good because now you get your safety net, and now it's treated like a static account with the 10K buffer. It's fine, but it forces you to trade bigger to maintain consistency. So your goal is to know that and scale your risk higher as appropriately. We give you the equation to trade the right amount of contracts to the size of your account as you get bigger to get those consistency rules kind of wiped. So basically, we mathematically work around the consistency rule. I give you the equation to position size to get around that. But you have to think about it like this. The more, and these are rules of thumb, the more strict the company is, the higher the probability you get paid for being a good trader. If they don't have those consistency rules, just think of it like this. Like with, you know, what is the one that, the race car one that blew up, right? Race car trades, whatever the fuck it was called. Like these guys had essentially like the weirdest, easiest, like too good to be true funded thing. But the thing is that you need to race and get your payout up front like a fucking pyramid scheme, because as everybody's taking payouts, it's the people at the tail end who get screwed because the people at the front end made the company insolvent because they got paid too much. If there's no rules, then the probability of you not getting paid out is very high. Fast track trade, race car trading, yeah, whatever. The website looked schemish from the start. Like, let's get you funded as fast as possible. Vroom, vroom, let's make them all race cars. I'm just like, this is not gonna... You guys understand, right? When ETF and all these other companies have good consistency rules, it's so that they don't go belly up, which means if you do well, you're going to pass. You're going to get paid. So as a trader, you care about that. You care that the probability that you're not screwed is high. You don't want to get screwed. He's a McLaren guy, not a Lambo guy. Oh, yeah. Mistake number one is when your prop firm guy is driving big fancy cars, they're paying themselves out really heavy at the start with a very bad risk model, then they run out of money at the tail end. You got to be very, very cautious about that. Now, I gotta give a shout to my buddy Jay Dunn. I don't know if you guys know Jay Dunn Trades. He just started a prop firm called Funded Family, My Funded Family, or Funded Family Futures, something like that. I don't know anything about it, but I was chatting with him the other day. They're getting off the ground. You know, obviously, he's a pretty honest dude. So I might just check them out just to see what it's like. Let you guys know. I like when prop firms are started by actual traders. They get it. You know, obviously, if you start a prop firm, you're just looking to make money. It's like any business. But also, you know, nobody's designing themselves to lose money. And you want to trust somebody that's going to put together like proper risk models. People at ETF do proper risk models. That's why it's harder to pass. But other rule of thumb is that when it's harder to pass, it's also cheaper to buy. Because the other rule of thumb is the harder the rules, the higher the probability you get paid out, and the cheaper the eval process usually is. The easier it is to get paid out, the more expensive it is on the upfront. So really, you guys have to understand, tip for tat, all prop firms are equal. They're all exactly the same. There's a risk model of a basic math equation. Money in minus money out equals accumulation, okay? If accumulation is greater than overhead, then you're winning. Okay? The money out, the money in is a function of their marketing and the cost it takes to bring people in. The cheapness of the account, the demand for that account. The money out is a function of your success rate as a trader. They make it cheap to increase this one. They make it hard to decrease that one. But at the end of the day, the accumulation is still the same. It needs to be greater than the cost is to run the business. It's an engineering problem. So they throttle these two things. The harder it is to pass, the cheaper they make it. The easier it is to pass, the more expensive they do to make it. But at the end of the day, the accumulation is relatively exactly the same. It's called robbing Peter to pay Paul. It might be cheaper here, but there's a consistency rule here. There may be no consistency rule, but it's a more expensive activation here. It's always the same exact. Every prop firm is exactly the same value. There is no one that is more valuable than the other. They're all exactly the same. They're all exactly the same. So what you care about as a trader is which part is most important to you. Do you get paid? Yes. You can separate them very well with who has scandals and who doesn't. If there's scandals, just don't risk it. There's a lot of them that really don't have any payout scandals. I've heard through the grapevine, Brett Simba's prop firm pays out very well. They don't have scandals. They've done very well. Tradeify, I think is what's called. Top Step doesn't have scandals. ETF doesn't have scandals. You know, have people saying, "Hey, these guys delayed my payout by like a month." You don't want to deal with that. What's up, Life Prop Firm Trading? What's up? What's up? All right. Anyways, guys, the goal is to understand that there's no difference between the prop firms. There's none. The rules may be slightly different, but you're paying less for a harder experience. Now, the question that you have is harder experience is relative. They're all very hard. They're all varying degrees of hard. They're all designed to squeeze out more traders for the money they bring in. If it's cheaper, they're going to bring in a lot more. Usually if they're cheaper, you can buy more accounts. The Apex ETF model, you can buy up to 20. But as a result of you being able to have more accounts to lower their risk, they make them harder to pass. So the question is, if you want an easier path to the end, with slightly less hard rules. Again, they're all hard. They're just varying degrees of hard. You're going to pay a little bit more money to get through. Top Step is one of the more expensive ones, but also one of the easier ones to get paid. They only allow you to have 5, again, because it's easier to get paid. So you guys have to realize, if you look at the whole thing, they all have like these underwriter type risk analysts there that look at the risk of the company, if they're a good one. Vroom Vroom race car trades, they didn't have a good one. They're out there buying McLarens for themselves and blowing up their own company, okay? They had a very terrible risk model. But a good company with a good risk model is going to make sure they survive, because if they survive, you survive. And that's really what you care about. So I like to compare like all of them by saying, you know, you can put them tit for tat, but the real handles you care about is how much it costs you per month to get the accounts, how many accounts you can get. So multiply that together. If you can only buy 5 accounts for $200 each, that's $1,000. If you could buy 20 accounts for $50 each, that's also $1,000. It's the same amount you spend per month, so it's not going to matter because you're paying the same amount. It's how much you pay per month that you care about. Generally speaking, if the total amount you can buy per month is more, it's going to be a little bit easier to get past. There's going to be fewer consistency rules, easier ways to get in, fewer trading days to get funded, yada, 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 yada. So I'm going to pay a little bit more. I think about like churches. You guys familiar with churches in this country? Everyone takes, again, it's not a religious conversation. I was born and raised Catholic, but I'm kind of like a spiritual whatever. So we're not going to talk about religion here. But churches kind of take this thing where it's like they take the Bible and everyone interprets it slightly different. So each religion is like a slightly different interpretation. Well, we believe this, while you believe that. And we interpret it differently. So this is our group. You interpret it differently. This is your group. And most religions are on the same differences, right? It's like trader funding programs. It's the entire risk is the same. God is the same everywhere. But the way it's interpreted is different. Let's make it cheaper here, slightly more expensive there. And everyone has a different philosophy for starting a new prop firm. But they're all promoting something like, hey, we're cheaper, but then it's harder. You know, it's like, hey, get funded in a day, but then it's like, chances you can blow up is higher. It's like, there's a little bit of different interpretation every time. The goal with funding programs is to get in and get out as fast as you can. Get your payout in a month, and don't pay for the month. Don't pay for lifetime activation fees, guys. Make your money in the first month. I've been doing that model repeatedly. It works. The probability is really high that you're going to bust. So make sure that when you go funded, your best trade is your first trade. Because you need to achieve the safety net, which basically converts all your trailing drawdown into a static account. So you eliminate one of the rules that makes it hard to pass. So trailing drawdown, right? As your account starts at 0, there's some kind of trailing drawdown that follows your gain. As you make a certain amount, the trailing drawdown follows you up to a certain point. Usually it's like a couple $100 over the starting point or whatever. And then from that point, it is a static loss account. This is what's known as the sweet spot. Okay? As soon as you achieve the sweet spot, whatever the amount of time it takes to pay out, if they say 10 days to pay out, okay, then for the $80 you spent for a month, you have 10 days inside of that sweet spot to trade. Your first trade should be trying to achieve that sweet spot. So you're going to wait and wait and wait and wait for one of our 90 or 80% setups to hit that first trade hard enough to get into the buffer zone to where now you can lose 2 or 3 days before you blow up instead of 1 day here. So wait for your first trade. Wait and wait and wait. Today's the day. Hit it. Boom. Okay, I'm in the sweet spot. Now I got 9 more days to get my payout. And as soon as you get to your 9th day or 10th day, you have beat the odds of the casino designed to squeeze you out. As soon as you beat their game, take all that you can into their pocket and your pocket, and then you're done. Whether you keep trading this account or not, it's up to you. If you blow up, oh, darn, start all the way over at the next sale. And make it to this day, because this day is designed as part of their risk model. This is a mathematically chosen day to minimize their risk. If you beat their game of 10 days or 15 days or 20 days or whatever it is, you beat their game. That's the finish line of the game. Take all the money you can and put it into a real futures account and then go from there. Why do I think it's not good to not copy trade? Because of the idea that you give a higher probability of making some money by not doing that. I'll give you an example. Because it's statistically proven that you're going to lose a lot of trades, or statistically proven that you're going to hit a drawdown limit or some kind of squeeze out limit where you get kicked out of the program. So an example, if I have to long, if I have a trade set up on QQQ today, say we open here and I usually long from here. And I also have a second trade where I long from here to there. Both of them are high probability trades. This one might be a 90%. This one might be an 80%, right? If I were to copy trade all of my trades here as one thing, if I get this one trade wrong, they all lose. The goal is to make some money that offsets your expense of getting all the accounts you get. So what really is helpful to understand is that dollar cost averaging is the way to win any kind of trading. I dollar cost average in all of my trades. My real trading, I always DCA. They don't let you do that in a lot of these trader funding programs. Why is there no DCA rule? Well, you have to no DCA allowed. Why can't I long and then long some more and then long some more and then long some more and just keep longing and eventually we make money? Because martingales with no risk to you ultimately work. You have infinite amount of entries and fake money. So you can tilt the martingale win rate into your favor, because the way martingale fails in real life is because you don't have infinite money and infinite iterations to play. But if you're only paying $10 for these funded accounts or $80 or whatever it is to activate them, you basically have infinite money because it costs you nothing to keep adding to a position. Whereas in a real martingale scenario, you got to keep doubling your actual bet with real money. So you're not going to actually really martingale something. But in the funded world, you can. In the funded world, it works. It works so well that you beat the house every single time with the DCA strategy, which is why they don't let you do it. And the rule of thumb with trader funding programs, if they don't let you do it, it's because it works. So with no risk to you, you can martingale yourself into big payouts. So most of them have no DCA rules because of that. So to get around that, don't trade all your accounts at one spot. In theory, divide it up. Trade 4 of your accounts there and 4 of your accounts there. Statistically, some of them will make money. Some of them might blow up, but you don't have a situation where all of them blow up. The probability that you get this trade exactly right is much lower than if you trade here or here, because both of them are high probability trades. So you must trade both places. Normally, you would DCA at that exact spot. I'd buy at a high probability, high probability. Our setups are 90%, 80% on these two trades. Actually, this is also 90%. This is red. Mean reversion. In either case, just think of it being like high probability setups. Stock market is random, so I can't predict which one would work, but I want to play both of them. So it's better to split up your trades, because if these guys don't blow up and I never enter this one, here, look. If I enter this with 4 and they don't blow up, then those 4 made money. I might not have made money with 20, but I made some money with some of them. If these 4 blow up and these 4 don't, I still made money with some of them. And if the sale's going on, it cost me $10 to get back in. So it's not DCAing. It's allowed in the rules and do it. You have to be smart with your rules. Yeah, so also the probability that you pick exactly the right pivot to avoid the drawdown is very low, that you can nail the exact pivot every day. The idea is that we trade in like probability zones. There's a probability here and a probability here. In my normal trading accounts, I'm going to trade both of them. Get in a small position here in case it falls. The drawdown was small, and then hit it again really hard here. Both of them are high probability setups. And here, anywhere above here is likely to be profit. And trader funding programs will let you do that a lot of the times because when you add to a red trade, they call it martingale rule. But the reason is that in the paper trading world, it works. So just tell yourself if they don't let you do it, it's because it's a winning strategy. So essentially, trading 4 accounts here and 4 accounts here is like a DCA. You got 20 accounts, do 4 there, 4 there, 4 there, 4 there. I mean, you can do it all day long. It's not breaking the rules, is it? You have to read the rules. Some of them, if it doesn't say you can't do it, then you can do it. That makes sense? So a lot of people will split their 20 accounts into batches of like 4 or 5. We teach trader funding program how to game the system kind of classes. So if you guys ever, like I said, take our courses. This isn't even the big juice. We give you some big juice in those classes. The market exposure. Yeah, I mean, it's also because the probability is really small that you're going to get exactly that pivot right. So the idea is you want to trade, most markets move like this. So you want to get in lower and lower and lower as markets are falling. The rule you want to think of is better to win some than to lose all. And so it means you don't put all your trades in one basket, in one spot. So I always tell people it's better to win some than to lose all. Your goal is to take just a handful of those accounts to their whatever day finish line. And whatever money is there, put it all in your pocket. And then feed your own trading account with it. That is the ultimate path of these sim to funded. Now, again, I have a theory that the sim to funded thing is going to be a thing of the past. I feel like regulation is going to eventually change where none of this is going to matter in the next year or two. I feel like sim to funded payouts are going to go away permanently. Risk it for the biscuit. There you go. That's another conversation for another day. Every Friday, we give away 3 free ETF eval accounts. So you guys come here for the drawings. We're going to do one on Friday as well. Maybe I'll see if I can let me do 6 because I didn't do last Friday. I think Apex just got rid of their DCA rule, by the way. I think that you can DCA as much as you want in Apex now. Just starting to, which kind of scares me because Apex is like also cheap. Cheaper and easier doesn't sit right with me. You know what I mean? Cheaper and easier is only a matter of time before they go belly up. I'm trying to find where they cut the DCA rule. How did Apex become? How they lower their risk? Where they how they robbed Peter, but where'd they pay Paul? Yeah, that's kind of the point I'm saying is like where they got rid of the DCA rule and made lifetime activation fee cheaper than the monthly. Buying tech, that's just the overnight dynamic. Overnight dynamic hedge for sure. I just moved it there. All right, if you guys haven't checked out Rock Scooter, we do 50% off our first month. You guys can check it out. Come to our classes. If you like the fire about trader funding programs, look, I'm futures trader, live futures trader. I win trading contests. I peaked in the top 5 in the Robbins Cup Global Futures World Trading Championship. I just got first place in ETF's October monthly championship. Crushed everybody in that contest. Oh, the trade against the pro contest I think starts this week against Scott Bauer. Maybe I should enter that CME group. Oh, they have a funky R&R. Oh, that's right. That's right. That's right. Catalan says very few are aware of the information you share here. I have this like magic ability to just see something and then see the math. Like that's like my brain was always, I mean, I'm an engineer. All my fellow engineers here and all you guys raise your hands. You know it. You can see something, read it, and your brain is like structuring the math part of it. Oh, that's what this really means. Oh, this is what that means. I get it. It's just a bunch of rules, but I'm seeing like, oh, this is where the risk is. This is where the reward is. Like I'm seeing the numbers as I read stuff. Like they train us in engineering school to like read a word problem, and all of a sudden you're already drawing a diagram about how it's structured, right? That's like the skill set you have. And like I read all the rules and I can see exactly what it is. Like years ago, when they had this thing where it was like you get promoted to live funded with all these different companies, they give you real money to trade with after you play the sim funded and you're good enough. I was like the first person to say, like I speculated, do they ban you from the sim thing once they give you real money? Like, oh yeah, a lot of them do that. Once they move you to real, you can't trade sim anymore. And I go, well, that's because if you're too good at beating the casino, they ban you from the casino. A live funded account is a shadow ban. They're banning you because you're too good. And I said all the companies are going to eventually do that. And Top Step just did it. Like I predict these things because I understand the risk of it. Top Step for the longest time lets you trade those XFAs and then roll the money into a live account, which is likely what's going to happen as the structure of all these prop firms are going to change. I think the future is going to be there's no more sim-funded payouts. Essentially, I think the future is going to be just like this. Now, let me give you another prediction. Like I predicted everybody was going to start removing you from sim once you go from the eval stage to sim to funded. To funded. If you join this, you get banned from that. Because here, you're taking the prop firm's money. Here, you're taking less of the prop firm's money in a one-time payout, and then now you're taking money from Wall Street. It's a risk-lowering thing. Every move you make in the firm is lowering the risk. So now Top Step's in this world of once you get moved to funded, you can't trade the evals. And all the Top Step kids are complaining like, oh, man. And they're like, some of them are like, yeah, it's good. It can be funded. And yeah, it's not. But it's like, the idea is that if you're too good, they're going to remove you. Instead of closing down your account permanently and saying, bye-bye, you can't come in the casino anymore, they say, here's 20K of real money. Have fun trading it. And so you're not taking hundreds of thousands of dollars of sim payouts from them. That's the whole reason to do that, right? ETF is one of the cheaper ones out there. That's why I like them. Very inexpensive. Whole 4 years ad guide. It's like problem solving, right? Okay. So the rule is in the future, this is my prediction, what they're all going to be like. Ready? All prop firms will be this in 2 years. Number one, you will trade eval and you will pass. And then you will go to step 2, which is a sim to funded, quote unquote. They will have these rules that say, right now, funded is more like an invite thing. They have a risk team that looks at you and says, this guy's too good, let's fund him. And then they tell you, you're too good, we believe in you, we're supporting you, we're moving you, like let's amp you up. But there's really kind of like another like risk lowering mechanism there. They don't say is like, we need to ban this guy because he's making too much money. So let's give him money to trade. And then they like, let's go in it together and let's make money with you, which is also the honest part of it. But they also need to lower their risk because, you know, if you're too good or gaming the system here, they're going to move you to funded. And you can go game the system and beat Wall Street traders. Like, this guy's really good. Let him go beat Wall Street instead of us. Okay. This is trading against them. This is trading against Wall Street. So in the future, what they're all going to do, at this stage now, you can all get payouts from here. You can out right here. Okay. And this is causing a lot of them to belly up because people are getting these landfall wins. It's making all the rules harder and stuff. I believe in the future, they're all going to switch to a new model. All second stage funded will have a balance. It'll say drawdown of 3,000. Like if the eval was like drawdown of 3,000 and you win 6,000 to pass, the second stage will be exactly the same thing. Drawdown of 3,000, 6,000 to pass. It'll be the same thing and repeat. And so as soon as you hit your profit target, then they will make it to where you automatically go funded. And they take this money and roll it into a real account instead of letting you withdraw it. So there's still a chance that you blow it up, but your risk to them is completely minimized to the amount you make. I feel like every single one of these firms will go to this model because it's the least amount of risk and a complete Nash equilibrium on the math where everyone wins something. It's the best model to have. They will never go belly up again, and you won't get paid out sim to funded. Now, what are the benefits of that? Well, because their risk is lower, the whole process will be easier. You won't have consistency rules, DCA rules, none of that. So essentially, in the future, especially if regulation changes and they're not going to allow you to take quote-unquote payouts for being a consultant or whatever they call it, an analyst fee. This is kind of how you're getting paid in this program. If regulation comes through and nukes this whole part of the process of sim to funded anyways, then the prop firms must go to this model to where whatever you make, they just fund you with in real account. It becomes a real prop firm. And what people mistakenly call these things prop firms, they're not even really prop firms. They're more like sim-funded bucket shops that skirt the rules. And if the regulation changes the rules, then they become real prop firms. So they give you money and let you lever up and trade the real money, which I think they all will become. They're all taking steps to go that route. The current step most of them are on, ETF and Top Step, are two of the better ones, are on the step. Once you go live, you can no longer play the sim. Did you know I'm banned from ETF? Although I'm promoting them, I can't play the sim for like 3 years. Now, those rules are designed so that they can survive, which means you are guaranteed to get a payout more than the other ones that don't have that rule. You keep that in mind. You want to cheer them on for making these changes because it protects you as a trader by not getting to the finish line and then they're not able to pay. You guys understand what I'm saying? So I think in the future, you're going to play the eval 2 times. That's how they're going to make their money, and they're going to make a fortune doing that. And then the money you make in sim to funded, they're going to take that money and not let you withdraw it, 1099. Instead, they're going to say, congratulations, you passed step 2, automatically funded with a real futures account, step 3. And guess what they're all going to do? They're all going to go become brokers, and you're going to be able to get your trading account through them. And in the funded stage, they're going to take commissions from you on top of it. I've called it. I'm going to give some credit to Tracer Matt because he also is making the same prediction as well. Tracer Matt's the one that told me he found a top step, the top step file with the NFA to be an introducing broker. So I already pieced together the structure in my head. They're going to move people right now. Funded is a way to just remove the high winners from the pool. And it's a very rare thing to get live funded. In the future, it'll be so easy to get a live funded futures account. And you will be funded by the prop firm itself. It will be a broker. You heard it here first. They're all going to be brokers in the next year or two. Industry is going to crack down and regulate this because of all the belly ups. They're starting to take notice. The CFTC, NFA are starting to take notice, and they're going to probably say no more sim to funded payouts. We're going to change the rules that you can't do it anymore. And the immediate recourse that all these firms have is to say, that's fine. We'll just take that money and literally fund a real brokerage account and bring you on. Let's trade it. And then for them to make some of their money back there, they'll just be brokers. And every trade you make, they'll take a couple bucks from you as a commission. I'm really good at predicting stuff. Let's see if I'm right. But the best part about it is that while you may not like the idea that you can't lottery sim to funded payouts anymore, don't worry about that because that makes their risk infinitely lower. So therefore, the path to get funded is infinitely easier. And because of that, the competition between firms will make it easier and easier and easier for you to get in. They're going to step over each other like the phone companies did in 2000s. 600 minutes with Singular. Oh, yeah, well, I get 800 minutes with Verizon. Oh, yeah, well, Singular's gave me 10,000. They all roll over. Oh, yeah, well, I get 20,000 minutes with my phone plan. Oh, yeah, well, I get unlimited minutes. See, once you get into a competition where you have least risk, because minutes cost them nothing. It's an arbitrary thing they set. Competition, therefore, lowers the price or gives you more of the free stuff. And so if it becomes easier to get funded, the prop firms are going to be racing to make their things easier than the last guy. Oh, yeah, well, they do this rule. Well, we don't do it. Well, we don't do this rule. Because they all have no risk at this point. They're going to give you a paltry amount of money, $3,000, $5,000, $2,000 to fund you. And you're going to get a real brokerage account. that they're going to take a big majority of it out in commissions. So they're going to make almost all their money back. About whatever monthly amount you spend with these guys, 10, 1,000, 2,000, 3,000 is about as much they're going to fund you. So essentially, they're going to operate in a profit model like that. Where everybody's going to get live funded accounts, but they're going to be small. And they're going to be with the prop firm that's going to take commissions. I've already predicted it, dude. That's it. And guess what? Then they're going to be in a space race to make it infinitely easier and faster to get funded. So you're going to have an easier time to get funded. But the Rob Peter to pay Paul is you're just going to get funded with a little bit less. And you can't take sim funded payouts anymore. The benefit of that is that you got a real futures account at that point. They probably will get rid of trailing drawdowns. They'll probably get rid of DCA rules altogether. They'll probably get rid of consistency rules altogether. And for you should all applaud the prop firms taking the step in that direction. That is where the future is going to be. So you can say goodbye to your TikTok joker trading 20 sim to funded accounts and posting pictures of payouts. That will all be dead in 2025. So enjoy the party while it lasts. But trust me when I say I'm usually right about these things. That's good because it's going to be easier to get funded. And more people will be funded. You almost want the brokerage accounts to be in a risk-free space race with each other. You know, I heard through the grapevine that Trade-of-8 was going to become its own prop firm as well, quote unquote, or have their own quote unquote funded prop firm service. Can't tell you who I heard that from, but I heard that from the CEO of one of the top 10 prop firms out there, and it's not ETF. So another friend of mine that runs a prop firm, they heard that Trade-of-8 is likely to do the same because they're gonna probably incorporate a model just like that. It's an introducing step to get you to trading a real futures account, and I think that the CME Group and all these other companies out there would applaud the industry going in that direction because it gets people in the real futures accounts faster. The CME would love that because they're going to make exchange fees off every trade. Your clearing firms will love that. They'll make clearing fees off every trade you make. The introducing brokers, all these prop firms would love that too because they'll make commission on every one you trade, every trade you take. The CFTC will have, NFA will have regulations changed to where you're not getting the workaround sim to funded payouts anymore, so that the risk goes down of these things blowing up and futures getting a tarnished bad name. And at the same time, everyone wins and you get an easier path to the top. So the industry has to go that direction. That's where everybody wins. And I don't know if I'm the only person that sees that, but do you guys see that where I'm trying to say? You want, if your prop firm becomes a broker and you get funded faster, then everybody in the chain eats better. CME, brokers, clearing. The regs are happy. They're no longer dealing with fast track trading and nonsense like that. They can get rid of the loophole sim to funded payouts thing. Futures will have a better look to it. Everyone wins, and then you get an easier path, and it's cheaper and easier. Maybe I'm the only one that sees it, but this is where it'll be. So essentially, I think it's great. How to read the chart now? Nasdaq is still strong-ish, stronger-ish. Resilience is negative, but it's still somewhat strong. Flat and nothing. There's no bearishness. I don't think the market's going to sell off. I like to see resilience improving. Longing from here to here is a trade I like to take. I'll take it one more time if we tap it. As it's starting to develop with a little bit of improvement, resilience, I'm still looking all right. Problem with NASDAQ is that we open bear zone. I don't bet anything further here. So from here to here could be another setup of the same thing. No Name says this lifetime is better than the lifetime you got in 2023. Dude, we've upped our service pretty big. We've changed a lot about how we took you guys' feedback, and we try to basically just super duper increase the quality of what we do here. Every trade you take, I'll be missing you. I'm glad you're enjoying like the newer version of our stuff. The daily Zoom call is huge, man. Like people that I think that was what resonates with people the most. Those afternoon Zoom calls we do. All right. So anyways, just when I say, you know, you guys are going to have a good time learning the prop trading game from us. I will brag that I have a workaround almost for every single rule that they give you in the funded stage. Like, you can't do this. I have a workaround for everything. I have a clever way to beat all of their rules. All of them. Or to like not just beat, but like to have a better chance of like dealing with it. ECA, I have an answer to that. SSC roll, I have an answer for that. Nvidia is showing a couple of things. Number one, on the bigger position, bull liquidating, bear liquidating. Nvidia is showing volatility. It's a megaphone pattern. It's going to stretch and become more volatile. Nvidia also from here is building a secondary range of bear resistance. So Nvidia is exhibiting what is normally a topping pattern right here. Once you start to see a bear zone popping in the middle near the current traded price, this is a topping pattern with bullish liquidation. So with also short squeezing is going to keep it from crashing, but the bull liquidating is going to keep it from selling really hard. So this type of pattern means that price is in a topping pattern. It's stable and becoming more volatile like this. It's almost like a megaphone. And so until the bear zone goes away, basically Nvidia is like a month of stability right now in this range. Shorts are squeezing not as fast as bulls are liquidating. So there is downward pressure on Nvidia. But again, it's still not that bearish. There's just resistance here. And Nvidia has bull supports right here, and right here, etc. So the megaphone literally gets as wide as this. So like if Nvidia dips to here, it's likely going to find bull support. For now, I tell myself Nvidia is bullish with a little bit of selling pressure, with support right at 110. If it sells, I'm going to long right back in here if it sells within a 2-week range, just 2 weeks away. So when I see it like this, I don't come in here and say, okay, I'm gonna long this. This is a clear sign of bullish liquidation. Nvidia is having waves down, and it might have a couple more waves down. But ideally, I mean, quarter two, Nvidia's 220, 250. Neil's on point. He gets it. Okay. So again, from here, it's like I'm not overly eagerly bullish yet, right? You have a really strong 140 is really strong resistance. 145. Bear zones in the middle of this area is strong resistance. Where's my phone? Oh shoot, I've got like, I forget, I got to start scheduling all this stuff for the move. I'm moving in 2 Fridays, you guys. Already packed up a lot of the boxes. About all the appliances. I got to move my electricity, my internet, all that stuff. Dude, y'all got to see the new studio I'm building. It's gonna be massive. So much stuff. I mean, it's the same stuff for the most part, but I'm decking it out a little bit better. Like I'm gonna have more. It's gonna look cooler. when I finally get a chance to move some. I have more space to play with. This room here is like, I think 10 by 12. The other option is 10 by 15. So it's like 3 more feet of space this way. So I'm going to have a lot more space to like fit in a few more things. I'm going to have a whole second setup for trading. Do I think an IC would be good for NVIDIA? I don't, in modes like this, I don't bet on increasing volatility. Neil, I don't. The space between the bear and bull is getting bigger, which means there's more volatility, which means it's hard for an IC because it's going to be hard to get your sell side strikes right, because it could blast through them or be at the money at them for longer, and she'll drain your theta faster. So the idea is that if it's getting wider, I don't like ICs, as it could probably get wider. Instead, in this particular setup, one could assume you have a width over time that's going to change. I connect the dots from here to here to here to here to lower to bull zone. So essentially, you know, your legs will have to be outside of this wedge like that. Things can change. The idea is instead is you might want to take the bet that it just doesn't stay in the middle. If it's getting wider, then you can take the bet that's going the other way. What's this one? The one that you're betting that it moves one way, it becomes more volatile. It's the other, what's the other one called? You're betting on volatility. Strangle? The other side of the IC? Wait, what is the betting options strategy? Shorting straddles or strangles. I think that's the one people do. Let me see if I can remember. I don't know all of these off the top of my head. It's the strangle. Yeah. You're betting that it moves away from the middle. That's not going to stay here. So a strangle would be where you hold a call and a put with different strike prices, but the same maturity and underlying assets. So basically, like, you're basically betting that it moves one way or the other. As you have illiquidity pockets, right, with increasing volatility, then you're going to assume that IPs move fast through the range. So wherever the middle is, which is actually here, you're betting that you avoid the middle. So essentially, the goal is that you would buy calls right here at 145. Calls like maybe week out or month out, somewhere in here, and then you buy puts at each of the lower basins right here. So you're betting that it's not going to be flat. You're betting that within a day or two or three, it's going to either move here or move there. And you're going to cash on the winning leg, and it will pay more than what you lose on the losing leg. And because you're channeling, you just close out the winning leg, and you hold on to the losing leg because the chances are it's going to tuck back in and pass the other way. Best trading stream. Thanks, man. Appreciate it, dude. See you tomorrow, man. Or come to our Zoom call at 3:30 Eastern. We do a Zoom call every day. You can see the bots posting. We have this 50% off of our monthly. Why is it not posting that? Oh, here it is. Go here. Hold on. You guys go here and check this out. You can do our platform and all of our stuff in our Discord for 50% off first month. Check it out. And we do a Zoom call, a training Zoom call at 3:30 every day. So the idea is in a strangle type trade, is that you believe that it's not going to stay in the middle. You're betting on volatility, which is basically like you're betting on breaking the range. And if you have clear resistance here and clear support here and volatility is getting wider, then you can bet on it moving. Even if the mean stays the same over time, you're betting on it moving, right? So if you buy both of them a month out, the puts and the calls might both make money. But essentially, a strangle loses if price doesn't go anywhere. And both your put and call loses. So if you think that the middle is avoided, and in the strategy of an IP, we tend to say that it moves from one zone to the other pretty quickly. It doesn't like to stay in the middle. If there's about to be some momentum on NVIDIA, then strangles the trading strategy that works, I think, in that belief system. Now again, it's not investment advice, but that's how I see it. So you buy your calls, you buy $1,000 worth of calls and $1,000 worth of puts, and you believe it's going to move. You're going to lose 1,000 of one, but you might make 2,000 or 3,000 the other. The way a strangle loses is if you make them too wide and it doesn't break either one of them, then you're kind of in a spot. Yeah. When's the option class coming? I don't know. I need to get a good options trader to teach it. I mean, I see options differently because I'm not classically trained. I can see, like, I don't know the names of the different trade setups. I just know how they work, like, in my head. I can say buy the put here, sell the put here. I can see it. So my options class would be too hard because I'd have to invent my own words for everything. So I need to get an options trader to come through and teach all the standard options where, like Ashton or somebody. Maybe I'll get Neil to do it. So, like, I had to look it up. I was like, wait, what trade is it that's betting on volatility? You're betting on NVIDIA not staying here at 140. You're betting on this being like a place that it's going to pass through. We're either going to have like 3 days down or 3 days up or 5 days down. It's going to move, right? And if you believe it's going to move, then strangle is the best kind of trade. But yep. If you believe it's going to go nowhere, then Iron Condor is a safe trade to bet that it stays here. You're basically selling vertical spreads on both sides. Credit here. As long as you take in both of those credits, you're good. And the market can stay bottled up, then condors are good. If you think it's going to tuck in the middle and stay kind of flat, you're just collecting premium at that point. If a strangle is if you're betting that it's going to avoid a straight line, like where you are now, I'm betting that we're going to avoid this area like the plague. It's going to move one way or the other. The strangle is collecting delta and IV. You're collecting a little volatility because it's going to move, and you're collecting delta. So. All right, boys. I'll take my 10K and walk away. Yeah, we should talk, dude. Neil, me and you should chat. Maybe I could bring you on, and Neil can set up like an options class or something. We do have the marketplace for you to set up and market everything, but we can figure it all out. And you come up with cool names for the RS trades. I know! Come up with my own names for stuff. Come up with like... I need to come up with a trade and call it the pickle. You know, after the dog. You know, we come up with like our own names. Spaceman. The rocket ship. Who decided to call it a condor? Well, you know what? Let's give it our own. Let's give it our own names. That's one of the problems with like our style, is because like everything that we do, we invented, right? Hedge pressure. You can't Google that. That's our term. Bull zone, bear zone. We invented all this stuff. I guess people probably call it bull and bear zone. That's a common name, but our application's different. You can't redistribution zone, things like this. People come here and they have to learn all a bunch of new words. That's a little different. Hey Matt, play YM from BLU now. BZB, MHP playing. Let's go. Future. Let's go, man. Got your IWM going? Ooh. Oh no, Dow. Let's go. What you got? The ball hammock. Oh shit. Let's go. Okay, like yeah. So it looks like over here, DIA was a pretty solid play today on the BLD. Yeah, it was. Yeah, this leg was good. This leg to next resistance is good. Not bad, not bad. The albatross is the largest wingspan. I love it. But they're bad luck. They are bad luck. You may tell me I sound like Drake. No, never told me I sound like Drake. That's cool. I like Drake. That's dope. Yeah, Neil, maybe we'll come up with something. We'll do maybe like a futures class or something. Get Neil to teach it. I mean, options class. That'd be cool. All right, guys. I'll take my 10K and walk away. We're going to call it a day. It looks like I like to rhyme, and I do it all the time. I'm a poet, and I didn't even know it. But my feet surely show it, because they're long fellers. My dad used to say. Anyways, for amazing poetry, rhymes, and trading techniques and lessons, feel free to join the Rock Security team. 50% off first month. You can check it out. Over 6,000 paying members. Actually, I guess by the paying members side, the largest paying community on the planet for futures trading. We're huge. And we drop knowledge bombs here every day. We do daily Zoom calls. It's like a lot more serious than the goofy streams we do. I obviously have a live trade in front of everybody. I go out and win trading contests, let you guys watch me do it. But we teach you how to do position management, risk management. It's a very strong part of my trading diet. It is the method that you must have if you're looking to be successful at trading. You must have risk management, position management methods. It's the only way to win at trading is to bet appropriately in the market. Picking the direction of the market is not how you win in trading. Stock market's random, but you don't have to be. Check out what we did at Rock Scooter, you guys. What is the code? You go to rocketplace.com, Matt. I'll type it in there right now. Click that link. You can see all the stuff that we do. Love for you to join our team. We're expanding very rapidly, and there's a reason for that. And we even have a special class on how to game the funding programs. Check it out. Love you guys. See you later.